Okay. Good morning, everyone. Welcome to Baiju's Exam Prep IAS. This is Sham Kagud here. If there is no issue with the sound, can you please give me a thumbs up so that we can start the discussion now? Done. Thanks a lot. Let's continue. Yesterday, what we have done, we discussed the concept of budget and finance commission. Do you remember that? We discussed the concept of budget and finance commission. Now, what we have discussed yesterday, before going forward, I know questions are there from budget and finance commission, fiscal policy. We'll take it up. MCQs are done. Basically, we need to discuss descriptive questions that we will take it up. Please don't worry. So, what we have discussed yesterday in budgeting and finance commission, we started with basically the budget accounts. I hope remember that we started with the concept of budget accounts, right? So fiscal policy we started with budget accounts. So in budget accounts, what we have discussed, basically that budget accounts are divided into two parts, revenue and capital. Revenue is further divided into two parts, that is revenue expenditure and capital expenditure. Capital account is divided into two parts, capital receipts and capital expenditure. Right. So, what is the basic difference between revenue and capital? Yesterday we have seen. Please revise that. After that, we have discussed what are the types of deficits. What are the types of deficits? Right. For example, we have discussed one revenue deficit. After that, right, the effective revenue deficit (ERD). After that, we have discussed a fiscal deficit, then primary deficit. After primary deficit, we have discussed a budget deficit and deficit monetization. A deficit monetization. Okay, so these are the types of deficits. After the deficits, we have discussed concepts related to public debt. What are the features related to public debt in India? Point number one, public debt basically means how much is the debt of government of India. How much is the debt of government of India? I hope remember the difference between the term public and overall. Tell me, do you remember this or not? What is the difference between a public debt and overall debt? Overall debt or also general debt? Public debt talks about only the central government debt, whereas overall debt basically means the central government plus a state government. Central government plus a state government. So, public debt, what are the features? Most of the public debt is internal in nature, correct? Most of the public debt is internal in nature, right? Only a small fraction is external nature. That is the precise reason, right? That is basically the precise reason, right? We say there is a very little exposure to exchange rate risk. Very little exposure to exchange rate risk, right? What is the basic idea of exchange rate risk? Yesterday we have discussed. If there is a change in the value of rupee against a dollar, automatically it will have an impact on your repayment. So internal majority of the debt, very little exchange rate risk, and most of the debt is in the form of long term bonds. Out of all the bonds, long term bonds value is much higher because it will provide you more flexibility to repay the loan over a longer period of time. And compared to many other countries, developed countries, in case of India, the debt of government of India is comparatively lower. So these are certain features. Then we have discussed how do we calculate overall liabilities of government of India, correct? How do we calculate overall liabilities of government of India? Overall liabilities. I hope remember the difference between the fiscal deficit and the debt of the government. Please do let me know. Fiscal deficit and debt of the government. Fiscal deficit simply means how much borrowing you are doing every year. This year, how much you have borrowed. Next year, how much you will borrow. Last year, how much you have borrowed. That is called as fiscal deficit. Whereas the debt simply means, right, how much is the total amount we are supposed to pay from consolidated fund of India. So overall liabilities are basically sum total of three components. One is the public debt. One is the public debt. Second one is liabilities or liabilities from the public account. Liabilities from the public account. For example, any small saving schemes where you have contributed money, the pension funds, etc. All of these are liabilities under the public account for Government of India. And the third one is extra budgetary resources, EBRs. Extra budgetary resources, that is EBRs, right? For example, I told you whenever government of India, rather than borrowing directly, that's very, very important. Please remember this. Whenever government of India, rather than borrowing directly, will ask its agencies to borrow from the market, that will be counted as a part of extra budgetary resources. Although the payment in later years is done by the government of India, including interest, because government is not borrowing directly, it is not counted as a part of the fiscal deficit of government of India. Then we have discussed FRBM as well as FRBM Review Committee. FRBM basically stands for Fiscal Responsibility Budget Management Act of 2003, wherein we made certain restrictions over certain policies of government. Restrictions in the sense, the argument was government should not borrow for consumption purposes, they should borrow only for creation of asset. That is the precise reason under the FRBM Act. Under FRBM Act, we basically said the fiscal deficit can be up to 3%, whereas revenue deficit has to be equivalent to 0%. We set out to achieve this particular target by 2008 and 9, but because of various reasons we have not been able to achieve. Even today we are struggling to achieve this. We are moving towards it. We are yet to achieve. Right, that is a precise reason. Over a period of time, Government of India set up a review committee, encasing a review committee, right, to review FRBM. And encasing committee says we should have targets for fiscal deficit, revenue deficit, as well as right, even the public debt, that is overall liability, overall debt of the Government of India plus state governments. And under FRBM review committee, although there is a recommendations to basically um, have an autonomous fiscal council. We do not have an autonomous fiscal council, but FRBM committee says that there should be certain situations such as natural calamity, war, whenever there is a contraction in GDP, etc. Only in such situations, government should be allowed to extend the deficit target that they've kept for that particular year. After FRBM, we discussed the concept of finance commission. Finance Commission. What we have discussed in the Finance Commission, basically, it is a constitutional body. It is a constitutional body under Article 280. Once every 5 years, President of India will set it up. It has a composition of 1 plus 4 members. One is the chairman or chairperson plus 4 other members. What are the terms of references? Under which circumstances they will give the recommendations? They will basically, most important one, they'll basically recommend regarding, right, the division between the central government and state government of the taxes from the divisible pool of taxes. That is the most important term of reference for a finance commission. Then we have seen what is the vertical devolution formula, which is given by 15th Finance Commission. What is the horizontal devolution formula? What are the parameters which are considered within the horizontal devolution formula? Then we have also seen what are the other total grants of around 10 lakh crore rupees. What are the other total types of grants which have been recommended? What has been the recommendation in the context of taxation, fiscal roadmap, defense, etc. So these are some of the very important things that we have covered yesterday. Please go through all of them very carefully. Now today, let's start with a new chapter. Right? Questions or descriptive questions we'll look at the end of the class today. So financial market will be the new chapter. Let's start. In financial market, what we will be covering, these are certain important concepts, very, very important. A lot of current affairs is associated with this chapter. Please understand it carefully. So these are the areas that we'll be covering under this, right? So we'll cover the concept of credit rating, what is a money market, what is capital market, what is a stock market, right? What is equity, what is preference, etc., etc. Now let me start with a basic idea. That is financial market. What do you mean by financial market? Financial market basically means it is a market where it is the market where instruments are issued. Instruments are issued and traded. Instruments are issued and traded. It is a market where instruments are issued and traded. For example, sir, what kind of instruments are you talking about? Please tell me, do you remember treasury bills? Let me know. Do you remember treasury bills or not? Sir, where have you covered treasury bills? We have discussed the concept of treasury bills under Reserve Bank of India. So treasury bill, can I call it as an instrument? What about dated securities? What about dated securities? Can I call dated securities also as instruments? What about shares? What about bonds? So I hope you understand all these are nothing but types of instruments itself. So argument is simple. The financial market is a market. And please understand, whenever I use the term market, do not imagine that there is literally a physical market. I hope you understand my point here. Whenever I'll keep on using the term market in this chapter, please do not imagine that there is literally a market and you will go, you will buy, like let's say tomatoes or onion. No, most of it is virtual now. Most of it is actually virtual. So I hope you understand, financial market is a market where instruments are issued and instruments are traded. And when instruments are issued or traded, can I simply say money will transfer hands? Let me know. When I say financial instruments are issued and traded, can I also say money will transfer hands or money will change hands? For example, sir, what do you mean by this? Imagine, right? Imagine government will issue a treasury bill to you through RBI. Government will issue a treasury bill to you, and when government will issue or sell treasury bill to you, don't you think you will pay money to the government? Simple idea. You'll pay money to the government. That is, from your hands, money will go into the account of government of India. So whenever you talk about financial markets, it's basically a market where instruments are issued, instruments are traded, and money will change hands like this. Now, financial market is divided into two parts. Understand this carefully. Financial market is divided into two parts. One is called as a capital market. Second one is called as a money market. What is the basic idea of a capital market and money market? Let me explain this. Understand this point. Imagine you start a company. Okay, imagine you start a new company. And when you start a new company, can I say you will require money for two purposes? One, to purchase a raw material, to purchase raw material, to pay salaries of the employees, to pay electricity bill of the company. And second, you will also require money for purchasing machineries. You'll also require money for purchasing machinery. You'll also require money to purchase a new company. You'll also require money to construct a new manufacturing facility. What is the basic idea? Why I'm writing it under two heads? Simple idea. Please understand this. Whenever you require money to take care of your day-to-day expenses, I repeat, whenever you require money to take care of your day-to-day expenses, this is called as working capital. This is called as working capital. And second, whenever you require money for creation of assets wherein you will spend money not on day-to-day basis, on let's say, right, a 5-year basis, 10-year basis, 20-year basis, right? In such a situation, this is money that is required for capital formation. This is the money that is required for capital formation. That is basically fixed capital formation. Now, please understand this. Whenever you require money for working capital purposes, you will borrow for shorter duration. You'll borrow for shorter duration. You want to borrow money for shorter duration. And whenever you require money for capital formation, you will borrow for longer duration. Please do let me know, does it make sense to you people or not? Will you take a 6-month loan to purchase a home? Think of it. Will you take a 6-month loan to purchase a loan? Of course, no, you should not do that. You should never do that, right? But on the other hand, if you require, right, let's say money to purchase raw material, right, raw material. So definitely, yes, you will take a loan for 3 months. Take a loan for 6 months because you know that after 2 or 3 months you will receive money, you will make a payment. So that is the basic idea. So for raw materials, salaries, electricity bill, etc., that is working capital purposes, you will borrow for a shorter duration. And second, for machinery, new company, new manufacturing facility, etc., you will borrow for a longer duration, right? For 5 years, for 10 years, for 20 years. Now, what is the basic idea? What is the use of all of this information? Please have a look at it. In money market, instruments which will have a shorter duration. I'll repeat the statement. In money market, instruments which have a shorter duration are actually issued and traded. Whereas in case of capital market, instruments which will have a longer duration are issued and traded. Any difficulty in understanding the first point? Please do let me know. In money market, instruments which will have a shorter duration are issued and traded. And in capital market, instruments which will have a longer duration are issued and traded. Now, please understand this. Although I gave an example of a company, please tell me government bond. A government bond that is basically a dated security, where do you think it will fall? I'll repeat the statement. A government bond that is basically a government security or a dated security, where do you think it will fall? Will it fall in the money market or will it fall in the capital market? All of you will agree? Or Baba? Some of you are saying money market. Wake up, my dear. Please wake up. Wake up. Class has started. Right? Don't you remember the concept of a dated security or a government bond? What is the specialty or let's say feature associated with the term bond? Can I say generally the term bond means it will have a maturity period of more than 1 year? Correct or not? Please remember, please by heart those numbers. Right? Don't you think government bonds or generally the term bond means maturity period of more than 1 year? Right? You have a government bond of 2 years, 3 years, 5 years, 10 years, 14 years, 30 years, 40 years. So more than 1 year. So where do you think it should fall? It should automatically fall under the capital market. Let me ask you one more term. Where do you think treasury bills will fall? Simple question now. Where do you think treasury bills will fall? Right? Don't you think treasury bills will have a maturity period of up to 1 year? Up to 1 year, 91 days, 182 days, 364 days. So these will fall in the money market. So money market means it will deal with instruments which have less than 1 year maturity period, tenure. Whereas in case of capital market, more than 1 year, that is, it could be 2 years, 5 years, 10 years, right? A medium term and a long term instruments are traded in the capital market. Second, it will mainly deal with financing the working capital requirement of companies, whereas capital market will deal with the investment decisions, capital formation requirements of companies. Banks are the most important participants, most important. Sir, is there anybody else in the money market apart from the bank? You will understand in some time. Please don't worry. We will have a discussion regarding instruments in the money market in some time. Please have patience. But banks are the most important participants. Whereas in case of capital market, financial institutions, including banks. Sir, apart from banks, who else is there in the financial institution? Banks, insurance companies, mutual fund companies, individuals such as you and me, right? Most of us are the participants in the at the capital market. In money market, retail investors are individual investors. In the money market, retail investor participation is very less, very much limited. Only in some of the instruments. For example, there is an instrument. We'll discuss that separately. There is an instrument by the name of certificates of deposit. Right? So, in very little instruments, individual investors are actually allowed to participate in the money market. Whereas in case of capital market, individual investors participation is comparatively higher. Do you understand the term comparatively higher? Let me know. Do you understand the term comparatively higher? Comparatively higher means how many individuals, to what extent they participate in the money market, it is a lesser compared to participation in the, right, let's say capital market. For example, in capital market, after some time you will realize there is a market called as equity market. Best example of equity market is stock market. Have you heard of Bombay Stock Exchange? BSE. Please do let me know. Bombay Stock Exchange. Have you heard of National Stock Exchange? Lot of individual investors participate in the stock market. So, in case of a capital market, individual investor participation is slightly higher, comparatively higher. Who is the most important regulator in case of a money market? It is basically Reserve Bank of India. Capital market, the most important regulator is SEBI, Securities Exchange Board of India. Right? This is a basic difference between money market as well as capital market. Can we go forward now? Can we go forward? Anybody has an issue regarding what is money market, what is capital market? Second point, money market will deal with working capital requirement. That is, the instruments which are traded are related to working capital requirements of the issuers. Whereas in case of capital market, it is more associated with investment and capital formation. Okay, can I go forward now? Please do let me know. Participate. I know it is early morning, sir. 6:20. I'm feeling sleepy, but please wake up. These concepts are very, very important. By the way, you will have to understand these concepts to understand current affairs. For example, sir, what is the requirement of reading all these right concepts? I'll show you the questions. UPSC has asked questions on these. And second, today's Hindu newspaper, there is an article on Fitch credit rating. I don't know how many of you have read about this article in the last 1 week. In today's Hindu newspaper, there is a very nice article on Fitch credit rating and USA. Today we'll discuss the concept of credit rating. Have patience. So you need to understand all of these to understand what is actually happening in the current affairs. So if you ask me, sir, in today's Hindu newspaper, any important article, Hindu newspaper, any important article, first one is Fitch credit rating. Please read that. Very nice article, important article for UPSC. Second, second is there is one more article in the central page. There is one more article in the central page, right? The article is basically related to Chips Act. Article is related to 1 year completion of Chips Act of USA 2022. Very important article. Why? I hope you are reading regarding semiconductors in recent times. Yes or no? Have you heard of term semiconductor? Have you come across the term semiconductor in the last, let's say, 2 weeks in context of government of India? So there is there is a lot of discussion that has been happening regarding semiconductor promotion of production in India. In USA, there is already a scheme which was implemented by USA for the last 1 year. Very, very important scheme for government of USA. Chips Act. Right. Under this, they have spent billions of dollars to promote, incentivize chip manufacturing in USA. So there is an article about Chips Act in case of Hindu newspaper today. Please read these two articles. Please read these two articles. Right. It's a must. Do not miss out on this. Okay, let me go forward now. Let me go forward. I hope you people are reading. I generally hope, I genuinely hope you people read every day the newspaper, because every day I make sure to convey a point to you people about important articles in Hindu newspaper. Please read those articles. At least be regular with Hindu newspaper. If you can't read one additional newspaper, right, at least read these articles that is there in Hindu newspaper. For example, yesterday I had asked you people to read on this one very nice article about mineral mining in India. Please tell me, did you people read about that article? Let me know. Did you people get time? Because you people are very busy with UPSC preparation. I know that. Did you people anyway get time yesterday in full 24 hours to read that very nice article on mining minerals in India? Government of India has made certain changes to MMDR Act. It is allowing private sector participation. It is opening up mining sector in India. Very lengthy article, but very important article. Very important article, right? So that's a reason I make it a point to tell you what is more important in Hindu newspaper. Please read them. Okay, now come back to this. Financial market is divided into two parts: capital market and money market. Now let me start discussing money market. Let me cover all the instruments, then we will shift to the concept of capital market. Now let's start. Money market instruments. First one, repo and a reverse repo. Please tell me, repo and a reverse repo. Did we cover the concept of a repo and a reverse repo earlier? What is a repo? Repo basically stands for rate of interest that is charged by Reserve Bank of India when they will lend, a very short term loan to bank. Very simple idea. I'll repeat it again. It should be a revision for you now. Repo rate is nothing but the rate of interest charged by RBI when they will give short term loan to a bank. That is called as repo rate. What about reverse repo rate? In case of reverse repo rate, bank will keep a deposit with Reserve Bank of India, and on this, bank will charge, that is RBI will pay rate of interest to the bank. That is basically called as reverse repo. Now point, right, simple point. Both repo and reverse repo, can I say these are short term? Let me know. Both repo as well as reverse repo, can I say these are short term? So if these are short term, right, automatically they will fall under the money market. So this is the first tool. If these are short term, automatically they will fall under the money market. In fact, I have not written the term here. Please remember, I have already given you the answer to this. Can I also write a treasury bills under the money market? Treasury bills under the money market because it's a short term. Now, first one is repo and reverse repo, and second is a call money market. Second one is call money market. Let's start. What do you mean by call money market? Call money market simply means one bank will lend to another bank. Very simple idea. What do you mean by call money market? One bank will lend to another bank. Now, many of you will ask me, sir, why? Why will the second bank take a loan? Let me ask you a very simple question. Imagine you are operating a bank and you are basically asked to maintain a CRR of 100 crore rupees, SLR of 200 crore rupees. Simple question to you people. Can there be a situation wherein you will fall short of CRR and SLR requirement? Let me know. Very simple question, right? Can there be a situation, and this happens? Trust me, this happens. Can there be a situation where you will fall short of CRR requirement and SLR requirement? So, where you would want to borrow for very short duration, where you want to borrow for a very, very short duration. Right? Why? Maybe next 7 days or maybe next day itself, right? Maybe in the next 14 days, you know that you will be able to collect money, you will be able to meet the requirement. But right now, only for one day, you might require money. Only for 7 days, you might require money. Only for 14 days, you might require money. So, in such situation, one bank will provide a short-term loans, very, very short duration loans to the second bank. And this is basically called as call money market. This is called as a call money market. Means what? Under the call money market, right, what we need to do is one bank will give a loan to another bank for a very short duration, right? This is called as call money market. Now within this also, technically speaking, if you borrow for only overnight purposes, if you borrow only for overnight purposes, overnight means what? One day. If you borrow for overnight purposes or one day purposes, this is called as call money. But if you borrow for more than one day, up to 14 days, this is called as a notice money. Anybody has a problem with this? I'll repeat it again. If you borrow overnight or one day, right? One day, this is called as call money. But if you borrow, let's say for more than 2 days, up to 15 days, generally it is given up to 15 days, then this is called as a notice money. Okay, that is basically the idea of a call money and notice money. Now, third point, if one bank is lending to another bank, don't you think they will have to charge a rate of interest? Let me know. One bank will lend to another bank. Don't you think they will have to charge certain rate of interest? Of course, yes. Of course, yes. They will have to charge a rate of interest. And the rate of interest that is charged is called as call money rate. That is called as call money rate. So the lender will charge a rate of interest. It is called as call money rate. So these are certain important points regarding call money market. Anybody has a problem, please do let me know. Anybody has a problem, please do let me know. Otherwise, I'll go to the next point. Lending rate will be higher than repo rate? No, not necessary. Not necessary. But repo rate, will it influence the call money rate? Of course, yes, it will influence. Is it similar to standing deposit facility? My dear, in standing deposit facility, do you keep money with a bank or with RBI? In case of a standing deposit facility, you will keep the money with RBI. But in call money market, one bank which has a surplus of deposits will keep deposits, will give a loan for a shorter duration to another bank. Who will decide the interest rate on call money? The market situation, the supply and the demand. Very simple. The supply and the demand for the money in the market will determine what is the call money rate. Because please understand this, call money rates will keep on changing on day-to-day basis. Call money rates can even change within a day also. That is, in the same day, call money rates can change. Why? Everything is dependent on supply and demand. Supply and demand. Everything is dependent on this. Right? So there is no fixed rate that you can say, sir, 4%, sir, 6%. Absolutely no. These are very dynamic in nature. What is the demand for money? What is the supply of money in the market will determine how much is the call money rate. Okay? Anything else? Anything else? Can we go forward? Alright, do not complicate it. Please do not complicate it. Keep it always simple. Why do people keep on complicating everything? Keep it simple. Right? What is the idea? One bank requires money, another bank, right, has more money. So this bank which will require money for a very short duration will take a loan and pay rate of interest. That is call money rate. That's it. Okay. So this is a call money market. Let me go to the next instrument here. Let me go to the next instrument. Commercial papers, CPs, commercial papers. In case of commercial papers, the companies, this is important, the companies will issue commercial papers for a short duration. What do you mean by short duration? 3 months, 6 months, etc. And borrow money. Simple. Right? Companies issue commercial papers and collect money from the market for 3 months or 6 months. But please remember, it is less than 1 year up to 1 year. Now, why do the companies require this kind of a money for only short duration? The companies require this to take care of their working capital, to take care of their working capital requirement, to take care of their working capital requirement. Because please understand, imagine you're operating a company. Very simple. Okay, do not complicate all these concepts. Imagine you're operating a company. Now, when you sell, right, let's say product 2, right, understand this. Imagine your company X, you will sell the product to, let's say, company Y. Now, please understand this. Don't you think after, right, after, let's say, 2 or 3 months, you will also, right, you will also get the payment from company Y here? Very simple question. Think of it. Right, your company X, you will sell certain raw material products, etc., 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 to a company Y. So don't you think after 2 or 3 months, and usually this is done, please remember, usually this happens. There's a concept of credit cycle. There's a concept of credit cycle. What do you mean by credit cycle? If you sell a product to company Y, the company Y will not make immediate payment. I'll repeat it. The company Y will not make immediate payment. The company Y will basically say, please give me 60 days. Please give me 75 days. Give me 45 days so that I can make the payment to you. Which means you know that after 45 days or after 60 days, you will get the payment. But till then, you might require money. Right? For that, there is one instrument that you can use. That is, you can borrow for a very short duration, which is called as a commercial paper. Company X will be issuing certain instruments in the market which are called as commercial papers. So concept of commercial paper was introduced back in 1990. There is one committee associated with the recommendation of promotion of commercial papers. Remember, name of the committee is Vogel Committee. Name of the committee is Vogel Committee. Vogel Committee recommended that we should promote issuance of commercial papers in India. These are the instruments issued with a tenure up to 1 year. It could be 3 months, it could be 6 months, etc. These are unsecured instruments. These are unsecured. Please tell me, what do you mean by unsecured? Please tell me, what do you mean by unsecured instruments? Unsecured means that there is no collateral provided, there is no guarantee provided, right? So these are unsecured instruments in the market. No security will be provided. We need to have a very good credit rating. What is the meaning of it? I'll discuss credit rating today, and I'll tell you what has actually happened in USA. Just give me some time. Just give me some time, okay? Please tell me, should every company be allowed to issue commercial papers in India? What do you think? What do you think? Right? Think rationally. Do you think should every company be allowed to issue commercial papers? What if a company such as Kingfisher will issue commercial papers, then it will shut down, right? Don't you think in that case, right, there is a lot of risk involved? So that is the precise reason there's a concept of credit rating. Credit rating represents what is the credit worthiness of a borrower. Simple. What do you mean by credit rating? What is the credit worthiness of a borrower? So just to make you understand in a simple way, do you remember the concept of CIBIL score? Let me know. Do you remember the concept of CIBIL score? Right? Idea of a CIBIL score. CIBIL scores are basically for individuals. CIBIL scores are given to you. CIBIL scores are given to me, etc., etc. So have a look at this. In case of a CIBIL score, we provide the score, right, to individuals, whereas in case of credit rating, we provide the credit rating to companies. We provide the credit rating to companies. We provide the credit rating to government. Best example in current affairs. Best example in current affairs. What have you read regarding USA government? Do let me know. What have you read regarding USA government? In case of USA government, have you come across the newspaper article? For example, today's newspaper, last week's newspaper. Credit rating of USA government has been downgraded. I hope you understand. Credit rating for the government has been reduced. What has happened? Why? Have patience. Have patience. Okay. So all the companies are not allowed to issue commercial papers, right? There are very few companies with very good credit rating. Only these companies are allowed to issue these commercial papers. Who can invest in the commercial papers? Individuals, the banking companies, non-resident Indians, foreign institutional investors, etc. These are allowed to invest in the commercial papers. Done. So these are certain, right, important points regarding commercial papers. Let's go forward. So first tool, right, I hope you understand what we are discussing. The first tool is repo, reverse repo. Second one is a call money market. Third one is commercial paper. Third one is commercial paper. Fourth one is certificate of deposit. Fifth one is commercial bills. Let me go forward now. Let me go to the next one. The certificate of deposit. Concept of certificates of deposit. Now, what do you mean by certificates of deposit? Let's start with an example. Here is a bank. The bank will collect deposits. Anybody has a problem with this statement? The bank will collect deposits. But have a look at this. The bank, imagine this, the bank has a lot of demand for loans. That is, there are a lot of loan applications which are coming to the bank, but the bank is not able to collect a sufficient amount of deposits right now. I'll repeat the statement here. The bank, right, has a lot of request for the loan. That is, there is a lot of demand for the credit in the market. But in case of the bank, they are not able to collect more deposits right now. So in that situation, what will the bank do? Bank will issue certain instruments for a shorter duration, 3 months, 6 months, etc. Generally up to 1 year, the banks will issue certain instruments called as certificates of deposit. Certificates of deposit, and use this money to provide loans in the market. Very simple idea. I'll repeat it again. The bank right now, the situation is that the bank is not able to collect more and more deposit, but on the other side, there is a lot of demand for loans from the banking sector. So in that situation, there is one option available for the bank to issue instruments in the market for a very shorter duration, either for 3 months or right for the 6 months, generally up to 1 year. Generally, because please understand, there are also certain international institutions or let's say global institutions which will issue certificates of deposit for longer duration also. That is more than 1 year also. There are certain institutes, but generally, the idea of a certificate of deposit is they will issue for a shorter duration, right? Whenever there is a requirement of money for the banking sector. Who are allowed to issue these certificates of deposit? These are issued by the financial institutions such as scheduled commercial banks, RRBs, SFBs, etc. Now, in some of the countries, RRBs are not allowed. In some of the countries, SFBs are allowed or not allowed. From one country to another country, combination will change, but guaranteed scheduled commercial banks are generally allowed. Right? That's say all India financial institutions. All India financial institutions. For example, NABARD. It's an all India financial institute. The EXIM, Export and Import Bank, that is also all India financial institute. So, right, these kind of all India financial institutes and right, basically the scheduled commercial banks, these are allowed to issue certificates of deposits in the market, collect money and use the money, and over a period of time, that is, let's say after 3 months of duration and after 6 months of duration, whatever the tenure is, they will repay the amount. Any problem with this? Who is allowed to purchase these certificates of deposit? Individuals can purchase it, companies can purchase it, etc. Right? These are the investors who are generally allowed, right? Generally allowed to borrow. I'm sorry, to purchase the certificates of deposit. Can we go forward here? Right? So these are short-term instruments. These are tradable. These are transferable. Tradable means what? Basically, you can sell these instruments in the secondary market. You can purchase these instruments in the secondary market. Minimum amount, right, to purchase this certificate of deposit, minimum amount required, right, is basically 5 lakh rupees. Right? Minimum amount required is 5 lakh rupees. Okay? Any issue here? Please explain by company and B, sir. It would be easy. My dear, certificates of deposits are issued by bank. I do not understand why you people not listen to me. What is the issue here? I am saying certificate of banks are issued by banks. You are asking me why are you not explaining company and company B? How can I say company A here? It is a bank. I don't understand what is the argument. I don't understand what is the argument here. These are instruments which are issued for a shorter duration. I hope you understand. Okay, let me repeat it. A bank will issue this instrument in the market for 3 months or 6 months, collect the money. These instruments are called as certificates of deposit. Now, you can purchase them, I can purchase them, any other companies can also purchase these certificates of deposit. Right? Now, these will have a very, very short duration. These are unsecured. These are tradable or transferable. You can sell them in the secondary market. You can buy them in the secondary market. This is a basic idea of certificate of deposit. Now, please tell me what is the difficulty in this? What is the difficulty? Tell me that. What is the difficulty? Sir, in tablet you said certificate deposit amount is 1 lakh. My dear, from 1 year to the next year, can the minimum amount required be changed? Simple question, my dear. right? Don't say, sir, last year you said this, 3 months ago you said that, right? Now you are saying this. From 1 year to the next year, don't you think requirements will keep on changing? Of course, yes, right? So whatever is the update, please update it, right? Some of the students, they'll keep on arguing against whatever I say. So then what is the difference between a certificate deposit and commercial paper? My dear, don't you find a difference between a company and a bank? You tell me. Right? You please tell me. Right? Listen. That's a reason. Listen to the class carefully. Don't you find a difference between a company which requires money and a bank which requires money? If according to you, bank and company both are one and the same, then yes, right? Certificate of deposit and right commercial papers are same. But you think Adani company is a SBI bank? Don't you think both are one and the same? Of course, no. Right? So that's a reason. Listen carefully. You people do not listen. You don't listen, then keep on arguing against whatever I say. Okay? Done. So this is a certificate of deposit. Next one, commercial bills. Next one is commercial bills. Now, what do you mean by commercial bills here? Let me start. Imagine company X will sell certain goods to company Y. Company X will sell certain goods to company Y. And remember this, company Y will not make, I repeat, company Y will not make the payment immediately. Right? Company Y will not make the payment immediately. Trust me, this is exactly what happens. Why? Company Y will purchase the raw material, produce the goods, sell the goods, collect money, and then right give the money to you. That is how the system will actually work. So company Y says, give me 45 days. Give me 45 days. After 45 days, I will give you this 2 lakh rupees. Assuming 2 lakh rupees is the value of the raw material. This is called as a credit cycle. This is called as credit cycle. Anybody has a difficulty in the term credit cycle? Let me know. Anybody has a difficulty in the term credit cycle? Right? Credit cycle means you purchase today, repay it after certain time period. That is called as credit cycle. Now, what is the guarantee for the company X that the payment will be done? They should have certain guarantees, right? They should have certain instrument to show that. In such a situation, there is one instrument that is drawn, that is written, which is called as a commercial bill. Right? In case of a commercial bill, these commercial bills are drawn by company X, that is the company which right requires to collect money. Drawn means they will write the commercial bill. So commercial bill basically are drawn by company X, that is by the sellers from the buyers. Right? Company X will draw a bill, write a bill saying that company Y will make a payment. Let's say hypothetically, understand this. Hypothetically, imagine this was sold on the 1st of January. The raw material was sold on the 1st of January. After 45 days means, can I say, again, don't worry, sir, exactly 31 days, etc. etc. Don't worry. 15th February payment will be done. All of you are okay with this? If you are going to sell on 1st January, after 45 days, Y says, I will make a payment. It will become 15th February. So the commercial bill will say that company Y will pay right on 15th February 2 lakh rupees. Simple. The commercial bill will say that company Y will pay on 15th February 2 lakh rupees to whomsoever is holding this commercial bill. This is the concept of commercial bill. That is, understand this, these are drawn by one business, that is a company, to another, right, in the name of the other, in because of credit transactions. Company X is selling raw material today on credit. Hence, company X will basically, right, have this kind of a commercial bill, which says that company Y will pay after 45 days, that is on the 15th of February, 2 lakh rupees. Anybody has a problem with this? Anybody has a problem with this? Please do let me know. If I want to make it much more simple, I will, right? I will sell raw material to you today. And let's say you are telling me you will give the money on 1st of September. So I will basically give you a commercial bill where you will sign and give the commercial bill to me. I will keep the commercial bill, and on the first of September, I will show you the commercial bill. You will pay the money to me. This is basically the idea of commercial bills. Can we go forward here? These are short-term instruments generally issued for a period of 90 days. Generally, but there is no hard and fast rule. Generally, these are instruments used for 90 days. These are tradable, and the banks also provide credit on these. Credit means banks also provide loans on these kinds of instruments. Right? Anybody has a problem with the term commercial bill? Please do let me know. After expiry, what will happen, my dear? Right? Listen. You people are not listening. If you're not listening, then there is no point. Right? Did you listen to the example where I said, I will sell the raw material to you? You are telling me you will make the payment on 1st of September. I will have the bill on the 1st of September. I will come to you, give the bill. You will make the payment to me. This is how commercial bills are utilized. This is how commercial bills are utilized. Right? What is bill discounting? Basically, it means you take the bill, commercial bill to the bank, take a loan from the bank. That's it. That is a concept of bill discounting. Any problem? What is the lieu of credit transaction? My dear, if you purchase raw materials today and if you guarantee a payment after 45 days, can I call it as a credit transaction? Arey Baba, let me know. And I'm expecting the answer from the person who is asking this question. If you purchase raw material today and you guarantee that you will make the payment after 45 days, can I call it as a credit transaction? Right? That is basically, right, in lieu of credit transaction. Okay? Any problem with this? Can we go forward here? Right? Can we go forward? So this is a right concept of commercial bill. Now, what is the meaning of tradable? Right? Is there any current affairs, etc.? Let me explain. Let me explain. What is the basic idea of, right, this idea of a tradability? Please understand. Right now, right now, there is a system which has been promoted by RBI. There is a system, right, promoted by RBI, which is called as a TREDS system. What is this a TREDS system? Trade receivables, trade receivables, e-discounting system. E means electronic, e-discounting system. Trade receivables, e-discounting system. Right? Trade receivables, e-discounting system. Now, this is very famous. Right? This is the latest system promoted by RBI, and this is very famous. Earlier, what used to happen? You go to a bank, you will basically get the bill discounted. Bill discounted means you will sell the bill to the bank and get the value from the bank. And earlier, right, please understand, earlier there was a very famous rate of interest which was called as a bank rate. Earlier, today bank rate compared to repo rate. I hope you understand my statement. Listen to me carefully. Earlier, bank rate was very famous. And in fact, it was the bank rate that was used, right, for the banks to provide discounting services for all these bills. Today, right, the bank rate is not very famous compared to repo rate. Repo rate is the most famous rate. In fact, repo rate is the policy rate around which other rates are adjusted. Right? So today, what is the system? What is the system promoted to provide facility for discounting of all of these bills? You'll understand what you mean by discounting. Just give me some time. There is a system promoted now by RBI, Reserve Bank of India, TREDS system, trade receivable e-discounting system. Now, what will happen under the trades system? Follow this. If you ask me, sir, what do you mean by the trades? Trades is nothing but it's a platform. It is a platform. It is a website in simple terms. Understand this system carefully. Imagine company A will sell raw materials, to B, and B says on, right, let's say 1st of October, just hypothetical date. Please understand this, just hypothetical date. Imagine, right, imagine today the sale has happened and the company B says on the 1st of October, I will pay you 10 lakh rupees. I will pay you 10 lakh rupees. Now, please tell me, if you are owner of the company A, if you are the owner of company A, will you require money on the 1st of September? Yes or no? Will you require money on the 1st of September? If you ask me, sir, why do I require money on the 1st of September? What about your working capital requirements? What about your working capital requirements? You would require money for salary payment. You would require money for purchasing raw material. Now, imagine you are the company A. You will take that commercial bill, go to B and show the commercial bill to B. Do you think B will make the payment of 10 lakh rupees on the 1st of September? Think of it. Do you think company B will make a payment on 1st of September? Right? Because you have gone to them, you have shown the bill to them. Do you think they will make the payment? They'll say no. Some of us saying yes. You're not listening. They'll say no. Why? As per the as per the bill, they have agreed to make a payment on 1st of October. So they'll simply say, not today. I don't have money. Please, as per the agreement, as per the bill, I will make a payment on 1st of October. Please come to me. But problem is you don't have any money now, right? To take care of your working capital requirement. Imagine you don't have money. In that situation, now there is a system called as a trades system. Under trades system, what will happen? Very simple. Whenever this transaction of buying and selling will happen, I'll repeat the statement. Whenever this transaction of buying and selling will happen, this is done online. That is, a receipt is generated online, bill is generated online. There is a one website called as M1 Exchange, right? M1 Exchange basically operates a trade system. Now, what will happen? Please understand this. A has a receipt, A has a bill which says B will make a payment on the 1st of October worth 10 lakh rupees. But A requires money on the 1st of September. So in such cases, what can A do? A can sell this bill. I repeat, A can sell this bill to another entity, let's say C. Sir, who can be the entity C here? C is basically a financial institution such as NBFCs. Lot of NBFCs do this, non-banking financial companies. Lot of NBFCs are doing this. C is any financial institution, let's say for example, non-banking financial company. These are called collectively as financiers. These are called collectively as financiers. Now A will take the bill, sell it to C, and all of this happens online. All of this happens online. So C will purchase this bill, and please understand, make a payment of 10 lakh rupees. Make a payment of 10 lakh rupees. But please tell me, if you are C, will you provide these services free of a cost? Let me know. If you are company C, if you are the financier, will you provide these services free of a cost? Right? Will you simply say, I'm doing charity, so take money? Absolutely no. You will charge certain amount of money. You will collect certain charges from company A. Right? You will collect certain charges from company A. And now please understand, financial, that is company C, is having a bill which says company B will pay money on 1st of October. So on the 1st of October, C will approach, produce this commercial bill and collect 10 lakh rupees from company B. Collect the 10 lakh rupees from company B. This is how the concept of discounting now is done. This is how the concept of discounting is done. This is called as a trade receivable e-discounting system. Anybody has a problem with the system? Please do let me know right now. Anybody has a problem? Please do let me know right now. Then how will A get profit? Where is the question of profit here? Please tell me. If you are the company, A, let me know what is the option available to you except this one. I'll repeat it. Please understand before you start asking, A is losing money, etc., etc. Let me ask you a very simple question. On the 1st of September, you need money to pay for your raw material. On the 1st of September, you need money to pay for salaries. Please tell me what is the option available to you. Let me know. What is the option? As expected, many of you are saying, sir, A will take a loan. Great. Absolutely great. A will take the loan. My dear, if you take the loan, are you not paying rate of interest there? Let me know. Right? You let me know. You're trapped now. If you take a loan, will you not pay rate of interest? So you are okay with a system where you take loan and pay rate of interest, and you are not okay with a system where you will get money and pay charges for that. Is it? Let me know. So you are okay with taking a loan and paying interest on that, but you are not okay with another system where you will get the money, but you will have to pay certain charges for it. How? How? Right? So I hope you understand. It's not a loss or win here. It's basically a facility which is available to you. It is basically the facility which is available to you. So that is basically the concept of trades system. Can we go forward? What charges are imposed by A? My dear, A will not impose charges. C will collect charges. Listen, A will not collect charges. C will collect charges. Can C be any bank? Generally, banks are not allowed under trust system. NBFCs are main participants. Banks already have a facility of discounting. Same idea. But now in a sophisticated manner we are doing. So I hope you understand this is not a novel idea of discounting is not a novel idea. It's not a new idea. Traditionally, it has been provided by the banking sector. Traditionally, it is provided by the banking sector. But now RBI says we want to promote more competition. Hence, we have made a system for that. That is called as a trades system. Can we go forward here? Where electronic means used in this? All these transactions are happening online. Do me a favor, my dear. Instead of asking me so many things, please do me a favor. Go to Google and type M1 exchange. I'm asking you to do this. Go to Google and type M1 exchange. You will see there is a platform. Right? Basically, which will provide a trades system only. It is a company which is providing whatever I've told you just now. How much charges would be there? There is no guarantee. It will vary from one authority to another authority. Again, same argument. A is running into losses. Are Baba, tell me, those people who are saying A is incurring loss, A is incurring loss, A is incurring loss. If you are the owner of the company, what is the option available to you? Are you not listening to me? But listen to me carefully. If you are the company A, what is the option available to you? You tell me. You please tell me what is the option available to you. Do not keep on counter arguing. Tell me you require money on the 1st of September. Where is the money available to you? You will again say, sir, loan. Right? Again, running around the same bush. Running around the same bush without listening to me. Okay? That is basically the idea of right commercial bills, right? And right now, current affairs, basically the idea of a trade system. This is very famous now. Right? This is very famous. Trade system is being promoted by Reserve Bank of India. Right? Why? Please tell me. Because of pandemic, don't you think the credit cycle has expanded? Let me know. Because of the pandemic, the credit cycle has expanded. All of you will agree with me, right? Because of the pandemic. And right, don't you think micro, small, medium enterprises, very, very smaller companies will be affected greatly because of this? So that is the reason now we are promoting the concept of trades system, where all these MSMEs can easily get their bills discounted, electronically get the bills discounted, and understand the advantage of trades system before jumping like this, sir, that this. There is an option available to you. Most of will say, sir, right, A is incurring loss here, so I will not do this. I will go to the market, take a loan. So point number one is, when you take a loan, you will have to pay rate of interest on it. There are no free lunches. You will have to pay rate of interest on it. Point number one. Point number two, how many of you are under the impression? How many of you are under the impression that you go to the market to take a loan, immediately you will get a loan? Think of it and do let me know. How many of you are under the impression that, right, you do not know the reality, right? You basically say, I will take a loan. Do you think the banks are waiting to immediately give a loan to you? Where are you then? No, right? It might take 7 days, it might take 10 days, it might take 14 days. But under trust system, the money will be given to you in a span of 1 or 2 days. In a span of 1 or 2 days. So you think of it. Would you prefer to take a loan, wait for 10 days, take a loan, wait for 14 days, take a loan, or you would prefer your bills get discounted through the trade system where you will get the money within 1 or 2 days, right? So think of it, right? Act like a businessman now. Think of it. You will understand what I'm talking about. So financial market is basically divided into money market and capital market. Now we are done with money market. Any problem? Can we go forward here? Don't keep on asking what is the difference between that, this, that, this. If you have listened to me carefully, there itself will understand. There itself will understand. For example, somebody is asking, what is the difference between a commercial paper and commercial bill? My dear, commercial paper is issued by whom to whom? Did you listen to me? Commercial paper is issued by whom to whom? And a commercial bill is issued by whom to whom? If you cannot listen to me, then it will create a problem. It will definitely create a problem. Listen now, please listen carefully. So one is money market, second one is capital market. Let me go to the next one. Capital market. Okay. Now in case of capital market, the point should be very clear to you. Capital market instruments which are traded are for more than 1 year. Instruments which are traded are for a period more than 1 year. Now, capital market is divided into two parts. One is a debt market, second one is equity market. One is a debt market, second one is equity. Now, what is the basic difference between the debt and equity? First and foremost, please tell me, do you remember the term debt and the meaning of the term debt? Let me know. Do you remember the term debt and the meaning of the debt? Debt means what? Liability. Correct? Debt means nothing. Liability. Liability means repayment. Money has to be repaid. Very simple. Repayment is there in case of debt. So understand this carefully. Whenever the companies want to borrow, whenever the companies want money for a longer duration, there is one option available for the companies. They can borrow from the market. I'll repeat the statement. Whenever companies want money for a longer duration, not for working capital purposes, for longer duration, right? How long? It will vary from one company to another company. One company would require money for 10 years, another company would require money for 20 years, another company would require money indefinitely. So requirement will vary, but basic idea is simple. The requirement is for a longer duration, more than 1 year. So one option is, they will go to the market, borrow from the market. Borrow from the market. And when they borrow from the market, can I call this market as a debt market? Very simple idea. When they borrow from the market, can I call this market as a debt market? And please have a look at the concept of the debt market now. In case of the debt market, we have instruments such as bonds. We have instruments called as bonds. But on the other hand, company, instead of borrowing all the time, can they sell ownership in the market? Think of it, right? Imagine you are the owner of the company. You already have lot of borrowings. Now, instead of borrowing again in the market, can you sell the ownership of the company in the market and collect money? Sir, any example of companies selling ownership in the market to collect money? Please tell me what has happened to Paytm in the last 2 years. Paytm, can I say Paytm has sold shares in the market? Paytm has sold shares in the market. That is basically selling ownership, correct or not? Selling ownership in the market, right? What about Zomato? What about Zomato? Zomato also has sold ownership and right money has been collected. Or your most famous, have you seen or have you heard of a program called as Shark Tank? Again, is it required for UPSC? Absolutely no. I hope you understand. Is it required for UPSC? Absolutely no. Don't say, sir, should I have seen this? Is it important? Should I start from season 1 or season 2? No. Even if you have not seen, nothing wrong with that. Absolutely nothing wrong with that. But if you have seen it, you would have understood the concept very beautifully, very easily. What do they do in Shark Tank? They will basically negotiate and say, I will give you 5 crore rupees for 2% ownership. Correct or not? I will give you, right, let's say 2 crore rupees for 4% ownership. I will give you 25 lakh rupees for 50% ownership. So what is happening here? What is happening? Right? Ownership is being sold. Ownership is being sold. So understand this. Whenever you sell ownership and collect money, this happens in the equity market. Right? Any problem here? Any problem? Equity means ownership. Equity always represents ownership. So on one side, company is able to get money, but it is under debt. Hence, this market is called as a debt market. On the other side, company will sell ownership and get the money. And because you are selling ownership, this is called as equity market. Can we go forward here? Let me know. Can we go forward? Let me focus on the debt market. We'll discuss a lot of current affairs now. Listen to it very carefully. First and foremost, right, what is a bond? Can I say bond is nothing but it's a debt instrument? At least now this should be okay with all of you. What is a bond? Bond is nothing but it is a debt instrument. Debt instrument means what? The issuer, the government or company, the issuer will issue this bond, this instrument, collect money, but with the promise of repayment in the future. Simple, right? The issuer will issue this instrument, collect money, but with the promise of repaying the amount in the future. So whenever bonds are issued, do you remember the term coupon rate? Let me know. Whenever the bonds are issued, do remember the term coupon rate, right? The coupon payment, coupon rate is given on the bonds. Point number 3, bonds can be issued by companies. Bonds can be issued by companies. Bonds can be issued, right, by global agencies. Remember this, even global agencies, global institutions. Sir, any example of a global institution? Best example of a global institution, right, is a World Bank. Right, so World Bank also can issue multiple types of bonds. Governments can issue, right, these types of bonds. So many authorities, right, many authorities like this are allowed to use bonds for borrowing purposes in the market. Okay, so these are certain important points. Now, what are the types of bonds? What are the types of bonds? Right, one is called as a convertible bond. Let's go one by one. Second one is called as a non-convertible bond. Third one is called as a zero coupon bond. Fourth one is called as a indexed bond. I'll repeat it. Convertible, non-convertible, zero coupon and indexed. Let me start with example 1 here. Imagine there is a company A. So company A will issue a bond to you. Let's say in 2023, company A will issue a bond to you, and the company A says you can, right, you can own the bond for a period of 3 years, and in 3 years, that is, let's say 2026, after 3 years, you can convert this bond into a share, that is equity. I'll repeat the statement here, right? You can issue a bond, I'm sorry, you can purchase a bond today, own it for a period of 3 years, and after 3 years, you can convert this particular bond into equity, that is into a share. What do you mean by share? Right? What are the types of shares? We'll understand in some time. Have patience. Now, please tell me, very simple question to all of you. Can I call this bond as a convertible bond? Let me know. Can I call this bond as a convertible bond? What do you mean by convertible bond? Convertible bonds are those types of bonds which can be converted from one type of instrument to another type of instrument. That is, in this case, the bond will be converted into equity. Bond will be converted into equity. These are called as convertible bonds. Can we go forward now? Right? Can we go forward from one form of instrument to another form? That is from the bond to the equity, that is called as convertible. Second one. Second one is a non-convertible bonds. Second one is a non-convertible bonds. What do you mean by non-convertible bonds? Right? Let me give a very simple example. Government bond. Government bond. In case of government bond, imagine government will issue a bond today in 2023 with a maturity period of 10 years. With a maturity period of 10 years. So have a look at this. After 10 years is over, after 10 years is over, that is in 2033, government will simply collect the bond back from you and pay the principal amount to you. So now can I simply say non-convertible bonds are those bonds which are issued as bonds and will mature as bonds. Let me know. Right? Bonds, right, are issued as a bonds and will mature as bonds. They cannot be converted. They will remain as bonds, right, till maturity. These are called as non-convertible bonds. Best example, government bonds. Best example is government bonds. So any difficulty here, please do let me know. Convertible bond, non-convertible bond. Any difficulty? Bonds are secured or unsecured? It can be secured also, it can be unsecured also. Interest is given on the bond? Yes, interest. Of course, I've written it in the slide. Please remember this. In case of bonds, these are right basically called as coupon rate. Tell me about convertible bond. Convertible bonds are those which can be converted into another form of instrument. Arey Baba, listen, no. These can be converted into another form of instrument, right? Meaning, you can convert this into, let's say, an equity. And there is one student who repeatedly says, this can be converted into debenture. My dear, please understand, there is no clear line of difference between what is a bond and what is a debenture. There is no clear line of difference because, trust me, in some of the countries, bonds and debentures are used interchangeably. There is no universal definition for this. In some of the countries, they use the term bonds and also debentures to represent the same instrument. And in some of the countries, they will say debentures are types of bonds. So there is no clear line of difference. So do not complicate the issue. Keep it simple. Convertible means these can be converted into another form. Non-convertible means these cannot be converted. They will remain. They will remain as bond itself. Can we go forward? How difficult is this concept? I don't understand. What is the difficulty in this? What is the difficulty? Convertible means convert into another form of instrument. Non-convertible means do not convert. Nothing will be allowed to you. Right? Nothing will be allowed to you. You can purchase this as a bond. It will mature as a bond itself. Right? Conversion will not be allowed. That is non-convertible. Okay. What are the base and conditions for this conversion? Think of these kind of questions you people ask. Some of you will keep on asking these kind of questions. Do you think conversion rate will be same for all the convertible bonds? Think of it, no? Please think of it. Right? Do you think conversion rate will be same for all the issuers? Conditions will be same for all the issuers? How? How? It will vary from one issuer to another issuer. Right? So again, I don't understand. Okay. And moreover, please do let me know. Do you think UPSC will ask you, please tell me what is the conversion rate for one bond to one equity? Think of it. Anyway, anywhere have you come across this question in UPSC? Do let me know. Please go through the last 10 years papers and please do let me know. Anywhere have you come across the questions that you people generally ask? I said in case of commercial bills, I said A doesn't have any option, so they will take it. They don't have any option. They will opt for discounting. Many of you will say, sir, A will incur a loss. Check last 10 years papers. Has UPSC asked you a question on whether A is incurring a loss or not? No, do not worry. Do not complicate it. Right? That's the reason my concern with some of the students. Again, nothing wrong with asking, but please understand. You want to learn economics completely in a span of 1 year. Assuming you'll read only economics. Assuming you'll read only one economics, you want to learn everything in economics in a span of 1 year. My dear, do you think that is rationally possible? Think, please think. If you're interested in economics, please go ahead. Read everything. Economics is a very interesting subject if you can understand it. But please do also let me know, right? Do also let me know. Do you think it is rationally correct to think that you'll be able to learn everything about economics in a span of 1 year? Think that also. Please do think. Okay. So one is convertible. Second one is non-convertible. Non-convertible. Okay. Third one, very interesting, zero coupon. Third one, very interesting, zero coupon. Now, what do you mean by zero coupon? First and foremost, listen now. Coupon rate, can I say, is nothing but interest rate? Let me know. Coupon rate, what is coupon rate? It is nothing but interest rate. And I said generally, understand this, generally, when the bond is issued, the issuer will give you coupon rate or interest rate. Meaning what? Let me give you an example. Let me give you an example. In case of a normal type of a bond, in case of normal type of a bond, imagine the bond has a value of 100 rupee, right? And you will purchase this bond. And the coupon rate, let's say 6%. Let's say coupon rate is 6%. Now, after 1 year is over, the issuer will calculate a 6% on 100 rupees and will give you 6 rupees. After second year is over, issuer will calculate 6% on 100 rupee, will give you another 6 rupees. So now can I simply say, on the face value of the bond, I'll repeat the statement, on the face value of the bond, the issuer is paying coupon rate to you. Anybody has a problem? This is a normal type of a bond, traditional type of a bond. On the face value means what is the value of the bond? On the face value of the bond, the issuer is paying coupon rate to you. Any difficulty here? Please do let me know. Now, what will happen in a zero coupon bond? What happens in the context of a zero coupon bond? Imagine company ABC who is issuing a bond with the face value of 100. They want to issue a bond with a face value of 100. They will not sell it to you at 100 rupee. They will sell it to you at less than 100 rupee. I'll repeat the statement. In case of zero coupon bond, the issuer is not going to issue this at 100 rupee. They will issue it at less than 100 rupee. Now, please tell me, instead of issuing this at 100 rupee, if the company will issue it at 90 rupees, can I say it is issued at a discount? Let me know. Can I say the bond is now issued to you at a discount? Now let's say whatever the maturity period is, don't worry. Arey Baba, listen. Some of you are saying how? My dear, discounting means what? Less than what is the price of the product? Do you know the term discount? Have you got a discount from the market? Have you received any discount from the seller? Discount means what? The bottle price is 100 rupee. MRP label is there 100 rupee. Instead of 100 rupee, they will sell it to you at 90 rupees. Can I call it as a discount or not? Arey Baba, can I call it as a discount or not? Please answer. Those who are saying very difficult. Those who are saying, sir, I'm not able to understand it. Right? If the MRP on this, there is a label 100 rupee. Now this will be given to you at 90 rupees. Can I call this as a discount? Of course, yes. So instead of the bottle, imagine it is a bond. Instead of bottle, imagine it is a bond. And the issuer, the value of the bond, on the bond value is written 100 rupee. The issuer will give it to you at 90 rupees. Simple. Right? Issuer will give it to you at 90 rupees. So you have purchased this instrument at 90 rupees. And let's say after maturity is over, upon maturity of this bond, the issuer will give you the face value of the bond. The issuer will give you the face value of the bond. What is the face value of the bond? Face value of the bond is 100 rupee. Now please do let me know. Can I give a statement to you people regarding this? Zero coupon bonds are issued at a discount, and upon maturity, the face value is given to the investor. Any problem with this? Right? Please do let me know any problem with this. Right? Zero coupon bonds are issued at a discounted price, and upon maturity, you will be given the face value of the instrument. These are called as zero coupon. Why these are called as zero coupon? Please tell me, if you remember the earlier example, can I say coupon rate is calculated on the face value? Let me know. Can I say coupon rate is calculated on the face value? In the zero coupon bond, is there any calculation of coupon rate? Let me know. Is there any calculation of coupon rate? There is no calculation of coupon rate. That is the reason these instruments are called as a zero coupon instruments. I hope you understand. These instruments are referred to as a zero coupon instrument. And now let me know. Please do let me know. Think of this. When you talk about the concept of zero coupon, can the instruments be issued for a short term as well as a long term? Think of this. I'll connect it to a very important point now. When you talk about concept of zero coupon means what? Interest rate is not calculated. Interest rate is not calculated. Right? They will be issued at a discounted price, and upon maturity, you will get the face value. That's a basic idea of zero coupon. Now, zero coupon as a concept can be applied to the short-term instruments, also to the long-term instruments. I'll repeat the statement. Zero coupon is a concept. Zero coupon as a concept can be applied to short-term instruments as well as to the long-term instruments as well. Sir, why are you discussing all of this? Whenever it is applied to a long-term instrument, this is called as zero coupon bond. Whenever it is applied to, right, a long-term instrument, these are nothing but zero coupon bonds. Whereas, sir, any example of a short-term instrument where zero coupon is actually applied? Best example for this is a treasury bill. Understand this carefully. Best example for this is a treasury bill. What do you mean by treasury bill? Instruments which are issued by the government. I repeat, instruments which are issued by the government for a shorter duration. Shorter duration means what? These are issued for a period up to 1 year. For a period up to 1 year. For example, let me show it to you. Let me show it to you. Imagine this is a treasury bill. Please tell me what is the face value of treasury bill. Let me know. What is the face value? Can everybody see this? What is the face value of treasury bill? 100 rupee. I will sell it to you. It has a maturity period of 91 days. I will sell it to you at 95 rupees. Simple. I will sell it to you at a price of 95 rupees. And after 91 days over, you will return this bill to me. I will give you 100 rupees. Right? Don't you think it's a concept of zero coupon? Let me know. Don't you think it's a concept of zero coupon? And one more example. One more example. Commercial paper. Commercial papers. Commercial papers are short-term instruments. I will issue this commercial paper to you and collect 90 rupees from you. I will issue this commercial paper to you and I'll collect 90 rupees from you. And after 6 months, I will give you 100 rupees. Right? Can I say it is a zero coupon? Zero coupon instrument? Right? Another example, it is a bond. It is, imagine a bond. Right? Has a maturity period of 2 years. I will sell this to you, collect 80 rupees from you. And after maturity period is over, that is after 2 years, I will give you 100 rupees. So now, any difficulty in understanding this concept, please do let me know. Any problem in understanding this concept of zero coupon instruments? Right? So zero coupon is a very common term. Zero coupon is a very, very common term. Right? Government uses it, banks use it, companies use it. But the idea is simple. Zero coupon can be used for short-term instruments as well as long-term instruments. What is the need? What is the advantage of such instruments? Please understand. The advantage is that whenever you are focused on earning fixed amount of returns, I will repeat the statement. Whenever your requirement is a fixed amount you want to earn, that is after 2 years. Think of this. There are certain investors, by the way, there are certain investors who will think like this. Their argument is after 2 years, I want to have 100 rupees with me. After 2 years, I want to earn 100 rupee on my investment. Now, please tell me, for these types of investors, don't you think a bond where it is issued at 80 rupees and upon maturity you will get a face value of 100 rupee, don't you think these kind of zero coupon bonds are made for these types of investors? Simple question to you. There are investors who think that, okay, after 2 years I should get a fixed amount 100 rupee. So for these kind of investors, don't you think zero coupon bonds are very safe to invest? That is the argument. So there will be investors in the market. There will be investors in the market. For example, some of you might be planning for a trip after 3 years. Some of you might be planning, sir, I want to take a trip to, right, let's say Middle East after 3 years. Expenditure is, let's say I expect it to be 5 lakh rupees. So don't you think for you, a bond which will provide 5 lakh rupees after 3 years is a right type of an instrument? You might be planning, again, very soon for you, but you might be planning for retirement. Upon retirement, that is, let's say hypothetically, your retirement is after 10 years. Don't you think these kind of bonds which will give you fixed returns, guaranteed amount after, let's say 10 years, these are the instruments for you? So I hope you understand. There are different types of investors. For some of the investors, these kinds of instruments are needed. So these are debt instruments, are issued at a discount lower than face value, and upon maturity, face value is paid to the issuer. Can be issued by both the government as well as private sector. Treasury bills are short-term instruments, use the concept of zero coupon. Treasury bills, very, very famous, use the concept of zero coupon only. But it's not a bond. Please understand, treasury bill is not a bond. Treasury bill is a short-term money market instrument. Can we go forward? Can we go forward? Sir, what if it is affected by inflation? There is a danger. There is a danger. Any type of instrument, for example, if you keep in fixed deposit, if you keep the money in the form of fixed deposit, will it not be eroded? That is, the returns, will it not be eroded because of inflation? Of course, yes. Now, for those people who are asking, sir, what if there is a inflation? There is one more type of a bond. Inflation indexed bonds. Right? Those who are asking, right, sir, what if there is an inflation? For your kind of investors, there is one more type of bond, inflation indexed bond. Now, what is the idea of an inflation indexed bond? Please understand this. In case of inflation indexed bonds, whatever returns you earn, I hope you understand, whatever returns you earn, the returns are connected or linked. You can use the term connected or linked or indexed to a price index. For example, let's say it is connected to inflation rate. Let's say it is connected, right, to inflation rate. So, sir, if it is connected to inflation rate, how my returns will change? Let's start. Imagine the bond has been issued. Maturity period is 2 years. Do not by heart calculation. UPSC will not ask you the calculation. Understand the concept behind it. Imagine the bond was issued in 2020. Okay, imagine the bond was issued in 2020 with a maturity period of 2 years. So from 2020 to the next 1 year, in the next 1 year, the inflation rate is 6%. Price levels have increased by 6%. So if the coupon rate is 10%, if the coupon rate is 10%, so have a look at this. If you calculate 100 rupee, that the amount of investment that you have done, and if you basically calculate coupon rate, interest rate of 10%, how much interest you should be earning? How much coupon you should be earning? You should be earning an interest of 10 rupees. But your argument is, from this year to the next year, from 20 to 21, inflation has increased by 6%. That is, the price levels have increased by 6%. So if the bond, I repeat, if the bond is an inflation indexed bond, if the bond is an inflation indexed bond, the issuer of the bond will link your returns to inflation rate. Will basically link your returns to inflation rate. Meaning what? Rather than simply paying you 10 rupee, now they will pay you 10 rupee plus 6% of 10 rupee. Any problem with the calculation? Rather than simply giving you a coupon of 10 rupee, they will pay you 10 plus 6% of 10 rupee. That will basically mean how much? 10 rupee plus 60 paisa. That will give you 10 rupee 60 paisa. So please tell me now, please tell me, can I call this bond as inflation indexed bond? Let me know, can I call this bond as inflation indexed bond? Index means what? Connecting. Very simple idea. Index means connecting. Whatever is inflation rate, your returns will be connected to inflation rate. And imagine next year, price levels from the base year, that is the year in which the bond was issued, price levels have increased by 10%. So your returns will be connected and increased by 10%. And if your bond is going to mature in that year, your principal will also be changed by 10%. You will be given 110 rupees. Right? Now, any problem in understanding how inflation indexation is done in this kind of a bond? If you ask me, sir, has Government of India issued any such bonds very recently? Absolutely no. Government earlier, right? Government earlier issued such bonds. Now they are not issuing such bonds. Can I go forward here? Can I go forward? Sir, it should be 111 rupees in 2022. How? The bond has a maturity period of 2 years. Right? So from 100 rupee, the inflation, Are Baba, look at the calculation, no? In fact, don't worry about calculation. But because you're asking me the question, compared to base year, the price levels have increased by how much? Please look at the calculation. Compared to base year, the price levels have increased by how much? 10%. So your principal will also be adjusted by 10%. Do the calculation. Compared to base year, right? Basically, the inflation has increased by 10%. So your principal will also be adjusted by 10%. That's a basic idea. Right? So these types of bonds are called as inflation indexed bonds. Now, listen to me very carefully. Next point is important. Question was asked on this only in UPSC. Imagine you'll purchase a bond. You'll purchase, example one, you will purchase a bond. And right in this particular bond, there is no inflation indexation. I repeat, example one, you will purchase any other type of a bond. No inflation indexation is done. And a second example, you will purchase a bond where inflation indexation is done. Now, please tell me, can I say in example 1, where no indexation is done, you are taking higher risk? I'll repeat it again. In example 1, no indexation. Example 2, indexation. So in example 1, when you purchase this bond without any indexation, are you taking a higher risk or not? So when you are taking a higher risk compared to second bond, will you demand a higher rate of interest or lower rate of interest? Very simple question to you. Right? In second bond, indexation is done. In first bond, no indexation. Will you demand a higher rate of interest, higher coupon rate, or a lower coupon rate? You will demand a higher coupon rate. My dear, those who are saying lower coupon rate, my suggestion to you people is don't enter into market. Trust me, do not enter into market. What is the logic here? If you're going to take a higher risk, should you not demand higher coupon rate? Think of it. If you are going to take a higher risk, should you not demand higher coupon rate? What is your logic? What is the logic behind your argument? Sir, I will take higher risk, but I don't want more returns. I want lesser returns. In that case, please give me an unsecured loan. Let me know. Please give me an unsecured loan, right? I would be very happy to take an unsecured loan from you people, because you do not understand the logic behind it. You will charge a very, very low rate of interest to me. So I hope you understand the logic here. In case of example 1, no indexation is provided, which means you're taking higher risk. You should demand a higher coupon rate compared to second bond where indexation is provided. Now, think of this. Imagine these two bonds are issued by the government. This is what was asked by UPSC. Imagine these two bonds are issued by the government. Now, can I say, think of this, please answer. Can I say, government by issuing inflation indexed bond can reduce its cost of borrowing? I will repeat the statement. Imagine these two bonds are issued by Government of India. Can I say, if Government of India issues, right, the inflation indexed bond, it can reduce its cost of borrowing? Cost of borrowing means how much coupon rate is paid by the government. How much is the coupon rate paid by the government? Because in case of example 2, just now we have decided. How? My dear, this is very bad. Very, very bad. Right? Why? Just now you have decided that. Now you are asking me how. Okay. Bond 1. Bond 1. No indexation is provided. No indexation. No inflation indexation. Bond 2, indexation is provided. If I say bond 1, if you purchase bond 1, you will demand a coupon rate of 6%. If you purchase a bond 2, let's say coupon rate is 4%. All of you are okay with this? Let me know. All of you are okay with this? All of you are okay why bond 2 will offer lower coupon rate compared to bond 1? Now, imagine this is issued by Government of India. Bond 1 issued by the Government of India. Bond 2 is also issued by Government of India. By issuing bond 2, can I say Government of India will be able to reduce its cost of borrowing? At least now tell me. By issuing bond 2, Government of India will be able to reduce its cost of borrowing. Cost of borrowing means how much is the rate of interest paid by the bank. By the Government of India. So this was asked by UPSC once. Please be very, very careful. It was asked once by UPSC. Generally, these concepts will not be discussed in book. But I hope you understand. If you apply your conceptual knowledge, you will understand the logic. Even if it is not discussed, even if it is not given in any book, don't you think, right? Application of knowledge is important. Sir, how do I apply knowledge? How do I apply knowledge? Simple. In one type of instrument, there is more safety for you. More safety means if inflation increases, you will get more returns. I hope you understand the argument, right? I hope you understand the argument. If inflation happens, your returns will be adjusted. So more safety. More safety automatically means what? Right? They will not give you higher coupon rate. So if it is issued by government, automatically lower coupon rate means government will be able to raise money at a lower rate of interest. That was the statement used by UPSC. Please think always whenever you write these answers or you appear for a test like this, please think of these concepts. Okay, done. Can we go to the next now? Important. This was there in newspaper yesterday, Mint newspaper. Okay, Mint newspaper. There is a discussion on sovereign gold bond. I'll give you the article later. Don't worry. Next concept. Now we will discuss certain new types of bonds. Certain new types of bonds. Right? Very, very new concepts of bonds are there in the current affairs. Let's discuss them. First one is a sovereign gold bond. Sovereign gold bond. Now, what do you mean by sovereign gold bond? Let me start with a very simple example. Point number one. India imports a lot of gold. Anybody has a difficulty in this? Anybody wants to counter it? Please do let me know. Right? The import of gold is very, very high in India. Point number one. Point number two, whenever you go to the market, purchase a gold, right? You are worried about the purity of the gold. Correct? You are worried about purity of the gold. The shopkeeper says that this is 22 carat, 24 carat, or let's say 18 carat. But what is the guarantee? What is the guarantee? There could be more impurities also. So you're concerned about purity of the gold. Third very important point, imagine you've purchased a lot of gold, let's say in the form of jewelry, in the form of rings, in the form of chains, etc., etc. Lot of gold is there. You have kept it in your home. You have gone to, let's say, UK for a foreign trip. You have gone to Maldives for a foreign trip. You have gone to Middle East for a foreign trip. Or you have gone within India, let's say, to Jaipur for a trip. Please tell me, will you not be worried about the security of the gold or safety of the gold? Right? Every 1 hour, after every 1 hour, you will keep on calling your friend, your neighbor, right? Your relative. Can you please go to my home and check whether the lock is safe? Right? Whether has anyone broken into my home? Whether the light in my home is off or on, etc., etc. So argument is simple, right? Import dependent, purity is a concern, safety is also a concern. So government of India says in such cases, why do you want to invest in physical gold? Rather, invest in an instrument. I repeat, invest in an instrument whose price is indexed. I repeat, invest in an instrument whose price is indexed. Do you understand the term indexed? Whose price is linked with market price of the gold. Very simple. Understand this carefully. Right? Why are you investing in a physical gold? Rather than that, there is instrument in the market which is available to you. If you purchase this instrument, the market price of the gold, as the market price of the gold will keep on changing, the price of the instrument will also keep on changing. Any problem in understanding this? For example, let me take a very simple example. Imagine, imagine this is one sovereign gold bond. This is one sovereign gold bond. And the price of this is equal to 1 gram of gold as of it, whatever the price of the gold is today. Let's say hypothetically. Today for 1 gram of gold, price will be 5,000 rupees. Today for 1 gram of gold, let's say price will be 5,000 rupees. Now, have a look at this. Have a look at this. If you purchase this, what is the price of this today? You will have to pay 5,000 rupees and purchase this. Tomorrow, if the price of 1 gram of gold goes up to 6,000 rupees, tomorrow if the price of 1 gram of gold increases to 6,000 rupees, what will happen to price of this instrument? Price of the instrument will also increase to 6,000 rupees. After 1 month, price of the gold, let's say hits 7,000 rupees. What will happen to the price of this instrument? Price of this instrument will again become 7,000. Now, sir, can vice versa also happen? Of course, yes. So after 1 year, the price of the gold will fall down to 4,000 rupees. Although it will not happen, let's imagine. Price will fall down to 4,000 rupees. What is the price of this instrument? It will also fall down to 4,000 rupees. This is basically the idea of indexation to gold prices. Indexation to gold prices. So these are type of government securities. I repeat, sovereign gold bonds are type of government securities which are issued in the form of gold, in the sense, rather than purchasing physical gold, you can purchase 1 gram of gold here. Imagine this is 1 gram of gold. Instead of literally purchasing 1 gram of gold, you will be able to purchase this 1 gram of gold. Second, invest in gold bonds rather than investing in physical gold. These are issued in terms of grams of gold, minimum 1 gram, and right, understand this, minimum 1 gram, and the value will keep on increasing. And please understand how much maximum you can invest, how much maximum others can invest. There is a limitation, different limitations are applicable. Right? Usually for individuals such as you and me, government will allow up to 2 kgs you can purchase, right, a sovereign gold bond. Bonds are sold through office branches of nationalized banks, scheduled private sector banks, scheduled foreign banks, designated certain identified post offices as well. Now the bonds, please understand the advantage here. The government says if you purchase a sovereign gold bond, let's say 10 grams, and let's say you will purchase a 10 grams worth of sovereign gold bond. Question number one, please tell me, will you be concerned about purity of the gold in case of a sovereign gold bond? Simple question. Will you be concerned about purity of the gold? Answer is no. Why? You're not purchasing physical gold here. Second, will you be worried about safety of the sovereign gold bond? Safety. Now, many of you will simply ask me, sir, what if I lose this piece of paper? For those people, please understand the next concept. Just to make you understand, I am waving this piece of paper. I repeat, just to make you understand, I am waving this piece of paper and say, this is sovereign gold bond. But in reality, what happens? In reality, what happens? Post 1996 in India, we have introduced the concept of dematerialization. Understand this. Post 1996 in India, we have introduced the concept of dematerialization. What do you mean by dematerialization? Today, any type of instrument, for example, right, a treasury bill, for example, dated security, for example, sovereign gold bond, any type of instrument, shares, etc., physical, they are not issued. They do not issue physical copies of these instruments. You will have to open an account which is very famously called as a demat account. I hope you understand why it is called as a demat account. You'll have to open an account which is called as a demat account, and in demat account, digital versions. Dematerialization simply means converting the physical copies into, right, let's say digital copies. Simple idea. Converting this into digital, right? That is, if you open a demat account, automatically these, right, let's say instruments will get added, right, will get added into your account. I hope you understand. So, should you be worried about safety or security of your gold bonds? Safety or security is not a concern here. And most importantly, government says, most importantly, if you purchase a sovereign gold bond, and when you purchase, whatever price you pay, I repeat, when you purchase a sovereign gold bond, whatever price you pay when you purchase, on that annually I will pay you 2.5% rate of interest. Any problem with this? I'll repeat it again. Whatever price you pay when you purchase this sovereign gold bond, annually on that price, I will give you 2.5% rate of interest. Right? So that is basically the concept of sovereign gold bond. Apart from this, government also says, just like you pledge gold, for example, all of you heard of gold loans? Gold loans. You will go to the bank, pledge your gold, give your gold to the bank and get the money. Loan. So in the same way, even in case of sovereign gold bonds, you can pledge these particular bonds and get a loan. That is basically the concept of sovereign gold bonds. Any problem with this? Any problem? Can we go forward here? On selling the bond, the original price will be retained and not market price, which can be a loss on commodity like gold. My dear, please understand. Let me give a very simple example. Imagine this is worth 10 grams of gold and you also have purchased 10 grams of gold. So please tell me, as the market price changes, when you sell it in the market, will you not get the current market price for this gold? Think of it. If you sell this 10 gram of gold, right, whatever price you have purchased, don't worry. When you sell it, whatever is the existing market price on that day, will you not get the same price? Applicable. Same is applicable for this. Same is applicable for this also. You might have purchased it at price X rupees. Whenever you want to sell it in the market, whatever is the existing market price, you will get that. Right? And please remember, these are bonds. Right? I'm going to the next point now. These are bonds. And when these are bonds, right, there has to be a maturity period. So these bonds will have a maturity period of 8 years. These bonds will have maturity period of 8 years. Right? So these will have maturity period of 8 years, and upon maturity, remember this, upon maturity, you will get whatever is the market price of the gold on that day. I repeat, upon maturity, right, you will get whatever is the market price of the gold on that day. Nobody will give you gold. Government will not give you gold. Whatever is the market price on that day, you will get the market price of the gold. These, right, basically are referred to as sovereign gold bonds. Sovereign gold bonds. Can we go forward here? Right? Can we go forward here? Right? So Government of India says there are a lot of advantages. In fact, the first sovereign gold bond was issued by Government of India in 2015. We started the concept in 2015. So please tell me, 2023, can I say sovereign gold bonds which were issued in 2015 will be mature this year? Think of it. Think of it. Why this concept can become important for you? Why this can become important for you? Because so far UPSC has not asked a question on sovereign gold bond. And this year, the bonds which are issued in 2015 will become mature now, which means, right, potential question for UPSC. So UPSC can ask you this. Please be very, very careful. Please be very, very careful. Sir, is 8 years fixed? Yes, in case of sovereign gold bond, 8 year is fixed. 8 year is fixed. Okay. Okay, now let's take a break. If there are any questions, please do let me know, right? So that I can address it, then we can take a break. Why individual participation is lower in money market? I hope you have understood the argument now. In case of money market, most of the times it is basically the banking sector which participate. Hence, individual investor participation is very, very less. Sir, we say that issue at a discount and paid at face value. It is right? Yes. Right. In case of zero coupon, the issuance is done at the discounted compared to face value, and upon maturity, face value is provided. Okay. What is par value? Par value means whatever is the market price on that day. Whatever is the market price on that day, that is meaning of par value. Sir, if SGBs are sold before 8 years, what will happen? Nothing will happen. Right? Whatever is the market price on that day, you will sell it. Right? You will get the market price on that day. Once again, explain interest rate on gold bond. Imagine you purchased this 1 gram of gold today, price is 5,000 rupees. So annually, government will give you 2.5% on 5,000 rupees. Whatever be the gold bond price on that day, it doesn't matter. Right? What is your investment on that? 2.5% will be paid. Okay. Are sovereign gold bonds indexed? My dear, you tell me. Are these not indexed to gold prices? Simple. Are these not indexed to gold prices? These are not indexed to inflation. These are indexed to gold prices. Okay. Taxation, yes, government imposes taxes. In case of the sovereign gold bond, taxes are applicable. In case of IIBs, taxes are applicable. Generally, government doesn't provide tax benefits here. Okay, any other concern? Any disadvantage of a sovereign gold bond? My dear, please ask your parents. Please ask your parents, or let's say, right, again, don't take it negatively. Don't take it negatively. Ask your spouse. For example, forget about yourself. Right? I'll talk about myself before you start getting offended for everything. If I ask my spouse, would you want, right, let's say 1 kg of a sovereign gold bond or 1 kg of a jewelry? Please tell me what will be the reply. Think of it. If I ask my spouse, would you want 1 kg of a sovereign gold bond or 1 kg of a jewelry? What will be the response? Right? Of course, all of you know the response. Right? She will laugh at me and say, "You keep the bond, give me the jewelry." Right? Because the argument is simple. In case of India, right, people love to flaunt gold jewelry. People love to showcase that they have lot of gold jewelry, especially in right the functions, and even without functions, right? Haven't you seen people who will wear 4 rings, 5 rings, big gold jhumkas, a big, right, let's say jewelry products, etc. So in case of India, demand for jewelry products is very high. Whereas sovereign gold bond, you cannot wear a sovereign gold bond. I hope you understand. You cannot, right, wear sovereign gold bond. So demand for sovereign gold bond is mainly from investors. But despite having this idea of a sovereign gold bond, even today the demand for physical gold is very high in India. Even today we are importing a lot of gold because the demand is very high. Okay, done. Are sovereign gold bonds tradable? I've answered this already. Yes, these are tradable. Okay. Okay. Let's take a break then. Let's take a break. Let's restart it at 8:13. Right. Let's restart the session at 8:13. Okay, welcome back. Can we start? Am I audible? Kindly do let me know if I'm audible or not audible so that we can start. Done. Let's start. So the next type of bond I want to discuss is the idea of a green bond. What is the idea of a green bond? Bond means these are debt instrument. Bond means it's a debt instrument. But why these are called as green bond? Green bonds are debt instruments used to raise funds for green or environment friendly project. What do you mean by this? Let's go a very simple example here. Imagine a company will issue this bond. Imagine a company will issue this bond and collect money from you. Collect money from you. Now this money, please understand, the company says they will use it, let's say for solar energy project. Let's say they will use it for solar energy project or they will use it for wind energy project. So can I simply say in this example, listen now, in this example, the company has issued debt instruments, the proceeds of which, the money from which are used for environment friendly project. Any problem here? Please do let me know. This is there in the current affairs, right? This is very, very famous now. This is there in the current affairs. Green bonds are debt instruments used to raise funds for green or environment friendly project. Now, generally, there is a list of the project. My recommendation is by heart the list. Simply by heart the list. Renewable and sustainable energy projects, clean transportation, sustainable water management, climate change adaptation, energy efficiency such as green buildings, sustainable waste management projects, biodiversity conservation projects, etc. So these are some of the types, some of the classification of projects wherein the proceeds from the green bonds are allowed to be used. And remember this, whenever any issuer, right, imagine I'm a company, I'm issuing this green bond to you. Before you purchase, I will have to tell you, I'll have to inform you in which kind of a project I'm actually taking the money into. For what kind of project I'm going to invest this money, I'll have to give you the information. This concept is called as a green bond. Now, who is allowed to issue green bonds? The government, right? Be it USA government, be it Indian government, right? Be it Nepal government, Bhutan government, China government, governments are allowed to issue. Any entity owned by the government is also allowed to issue. For example, in case of India, National Highways Authority of India, NHAI, National Highways Authority of India, NHAI, right, is allowed to issue. It has in fact issued green bonds. Private sector companies are allowed to issue. For example, have you heard of the company's name Ford? Let me know. Have you heard of the company Ford? Right, a Ford company is very famous. In fact, it became very famous in the last one and a half year in India because it exited in India. Right, so Ford has already issued so the green bonds. Multilateral organizations such as World Bank has also issued green bonds. So the argument is simple here. Green bonds are those types of debt instruments, the money wherein is collected and used only for certain environment friendly projects. And who is allowed to issue green bonds? Government owned entities, private sector companies, as well as even multilateral global organizations are allowed to issue, right, these kind of green bonds. Funds raised through this route is earmarked. Earmarked simply means reserved. It is earmarked or reserved only for certain specific types of projects. Certain specific types of projects. Okay, so these are called as green bonds. Now, in connection to green bonds, there is a particular term, greenium. There is a particular term, greenium. Please remember this, greenium. Now, what is the concept of greenium? It is a combination of two terms, green plus premium. Greenium is a combination of two terms, a green plus premium. Now, what is this idea of a greenium? Let me start. Point number one, right? Think of this very carefully. Imagine you are issuer of a bond. Okay, you are issuer of a bond And money that you have collected, you can use it for multiple purposes. Understand the logic behind all of this. Please understand this carefully. You are issuer of a bond, you can use this bond, that is money, for multiple purposes. But on the other hand, you are issuer of a green bond. You are issuer of a green bond, and now you will have to use it only for, let's say, solar energy project. Solar energy project. Now think of this and please answer. Think of it. Will you offer a higher rate of interest in example 1 or example 2? Please think carefully. Will you offer a higher rate of interest, that is better returns, right, in case of example 1 or example 2? Let me see how you people actually think. The right option is example 1. The right option is example 1 because there are multiple options available to you. I hope you understand why. Because you can use it for multiple purposes. There are no restriction. There are no restrictions on you regarding the usage of the bonds in case of example 1. But don't you think in example 2, there are a lot of restrictions how you are supposed to use this money? Yes or no? There is a lot of restriction. Can you use it for any other purposes? No, you will have to use it only for solar energy project. So obviously you will offer lower returns in case of example 2. Remember this. That is how economy works. Now, what is the connection of all of this to the term greenium? Let me give a very simple example. Let's start. What is the face value of the bond here? Let me know. What is the face value of the bond? 100 rupee. All of you can see this. Now, if I issue the bond to you at 90 rupees, can I call it? It is issued at a discount, right? Let's say coupon rate is 6%. Okay, let's say coupon rate is 6%. If I issue this bond at 90 rupees, can I call it as a discount? On the other hand, if I issue this bond at 102 rupees, if I issue this bond at 102 rupees, can I call it at a premium? Let me know. Very simple idea. Can I call this, right? That is, instead of 100 rupee, I will issue it at premium, right? That is at 102. I'll call this as a premium. Yes, it is called as premium issue. Now, why this is important? Look at the term green plus premium. Why it is called as a greenium? Understand this. Imagine the face value of the bond is 100. The coupon rate is a 6%. But I will issue, I repeat, I will issue this bond to you at a premium of 102. Please tell me, if I issue the bond at a premium, don't you think the effective coupon rate that I'm paying to you will become lesser? I will repeat it. Understand the concept here. Right? The bond value is 100. Face value is 100. But I will not issue it at 100. I will issue it at a premium price. That is 102. So if I give you 6% coupon rate, I will give it upon the face value of the bond. Correct? Whatever is the coupon rate, I will give it at a face value. That is, I will give you 6 rupees. But how much money have you paid? How much money have you paid? You have paid 102 rupees. So tell me, effective coupon rate, effective interest rate, is it lesser or higher? For me, for the issuer, effective coupon rate would be lower. So now, is the logic okay here with all of you? Is the logic okay? Point number 1, when you issue such instrument, you will offer lesser coupon rate. You should offer a lesser interest rate. But how do we do it in case of green bonds? We will do it by issuing it at a premium price. By issuing this bond at a premium price, we will ensure that the issuer will not pay higher coupon rate, they will pay lower coupon. That is basically the term green plus premium. That is, the green bonds are issued at a premium price. Right? Any problem here? Why will anybody purchase this bond? My dear, please tell me, in the last 1 decade, preference for environmental sustainability, has it increased or decreased? You tell me. In the last 1 decade, more and more governments are focused on environmental protection. Companies are focused on environmental protection. Even investors have become very cautious now. Right? I hope you understand this. Even investors have become very cautious. Right? That is the reason now there is a type of investment strategy which has started. There's a new type of investment strategy that is basically called as ESG investment. ESG investments, environmental, social, governance. ESG investments, very, very famous now. ESG investments, environmental, social, governance. That is under the ESG type of investments. Investors will invest in such instruments of companies which are focused on protection of environment, which are focused on social right issues, which are focused on governance. This kind of a model of investment has also started. If you do not trust me, type ESG in the Google and look at it. And please understand, some of you are saying, but sir, private sector should be focused on profit. Please tell me, even by investing in green bond, are you earning returns or not? Think of it. Even by investing in these types of bonds, are you earning returns? Yes, may not be very high, but are you earning interest? Of course, yes. So that is the reason there is a very, very novel concept of ESG now, very famous, right? Companies are focused on the ESG now. Okay, right? So this is the basic idea regarding the green bond. Let me go to the next one, masala bond. Let me go to the next one, masala bond. Sir, ESG not understood, my dear. There are investors who are basically investing on a concept called as ESG. What is ESG? Environmental, social, governance. That is basically the companies which, I'm sorry, investors who are interested in companies which are focused on environmental protection. If you are an ESG investor, if you are a type of an ESG investor, will you not prefer Government of India's green bonds? Let me know. If you're a type of ESG investor, will you not prefer Government of India's green bonds? Of course, yes. In fact, in the last 1 year, Government of India has issued multiple times sovereign green bonds. I hope you understand the term sovereign green bond. What do you mean by sovereign green bond? Sovereign means what? Sovereign simply means issued by the government. Sovereign means government always. So if you come across sovereign green bonds, what is the logic here? The government has issued green bonds. And has Government of India issued green bonds? Answer is yes. Right? That's a reason. That's a reason this has become very, very famous now. Sovereign green bonds have been issued by Government of India. Okay? Done. Next, concept of masala bond. Concept of masala bonds. Now, what do you mean by masala bonds here? Very simple idea. Masala bonds are generally the bonds which are issued outside India. Masala bonds are issued outside India, not within India, outside India. By whom? These can be issued by global agencies. I'll tell you why. Just have patience. These can be issued by global agencies. For example, earlier, World Bank has issued a type of masala bond. Right? Sir, why does World Bank issue masala bond? World Bank issued masala bond, use the money to provide financing for projects in India. And even Indian companies also have issued masala bonds, right, in the external market. Always remember this. Masala bonds are issued in the external market. Anybody has a problem with the term external market? Can I say outside India? External market means outside India. Anybody has an issue? External market is outside India. Now, rather than using the term external market, they can also use the term offshore market. They can also use the term offshore market. Offshore means outside India for us. Now, what is the logic of masala bond? What is the logic of masala bond? Point number one. there is a term called as external commercial borrowing, ECB, external commercial borrowing. Before you start asking me, sir, long form of ECB, I'll come back to that slide. Please have a look at this. What is ECB? ECB stands for external commercial borrowing. Now, what happens in external commercial borrowing? Commercial entities from India, I repeat, commercial, that is companies from India, can go to external market, borrow from external market. A very simple idea. ECB simply means companies from India can go to external market, borrow from external market. Sir, how can they borrow? Let me give a very simple example. Imagine a company from India will go to USA market, take a loan from a bank. Can I call it as a ECB? Let me know. Point number one, example one. Company A from India will go to USA in a bank that is from USA, will take a loan from this bank. Can I call it as an external commercial borrowing? Anybody has a difficulty in this? Second example, company will go to USA, issue a bond in USA. Issue a bond in USA and take money from the USA investors. Can I also refer to this as external commercial borrowing? Anybody has a difficulty in understanding this? So in the form of bond issuance, in the form of loans, etc., whenever Indian companies will borrow from external market, it is called as external commercial borrowing. Point number one. Second one, second point, whenever they want to borrow from external market, whenever they want to borrow from external market, they can borrow in the domestic currency. They can borrow either in a domestic currency or they can borrow in a foreign currency as well. We'll discuss this, just have certain patience. Whenever this company wants to borrow from external market, they can borrow in the form of domestic currency and they are also allowed to borrow in the form of foreign currency. The best example of this company borrowing in the form of domestic currency is basically masala bond. Right? It is basically masala bond. That is, Indian company will go to USA, issue a bond and collect the money in the form of rupees. How it is done? Please wait. I'll discuss that. Please wait. So the Indian company is allowed to borrow from external market either in the form of a domestic currency or in the form of foreign currency. And all of it is collectively referred to as external commercial borrowing. Anybody has difficulty with this? Please do let me know. Sir, how they borrow in domestic currency? There is a concept called as masala bond. I'll discuss that. Any problem? Now, all the entities which are eligible to receive foreign direct investment is allowed to use this route. All the entities which are eligible to attract FDI. What do you mean by FDI? Foreign companies will bring money, invest in India. Very simple. What is FDI? I'll repeat it. Right? What is FDI? Foreign companies will bring money and invest in India. Where? Imagine a foreign company will come into India, invest and set up a manufacturing facility. Can I give you best example? Best example. Apple company. Are you people able to read about these investments in India? Please do let me know. Or else another best example in recent times, Foxconn. Yes or no? Foxconn very recently has entered into an agreement with the state government to invest thousands of crores of rupees. Can I call this as a foreign company investing in India? That is FDI. So I hope you understand this. Any sector where FDI is allowed means the company can attract FDI, right? These companies are allowed to borrow under ECB route, right? They are allowed to borrow under ECB route. Now, how much is eligibility? How much is allowed to be borrowed under the ECB route? Until very recently, I repeat, until very recently, annually you are allowed to borrow up to $750 million or equivalent value in terms of rupees. Last year, Reserve Bank of India has actually doubled this to $1.5 billion. Right? Last year, Reserve Bank of India has doubled this to $1.5 billion. So under ECB route, you can bring up to $1.5 billion on annual basis. Why is this allowed? We'll go to masala bond. Don't worry, we'll go to masala bond after this. Why is it allowed? One, it will allow access to more market for companies to borrow in India. Very simple. Rather than being dependent on only domestic borrowing, now companies can borrow from other markets as well. Point number two, if you borrow, let's say in terms of dollars, think of it. If you borrow in terms of dollars, don't you think it will help you in easily making payments whenever you import any capital good? Is the logic okay? Think of it. If you borrow in terms of dollars, will it not help you in directly making a payment in terms of dollars to import a capital machinery? That is an advantage for you. Third, what if I say you take a loan in India, rate of interest is 6%. You take a loan in USA, rate of interest is 4%. So please tell me, don't you think this interest rate difference will work out in your favor? I hope you understand this. If you borrow in India, rate of interest is 6%. If you take a loan in USA, it is, let's say, 4%. Will it not work out for you? Of course, yes. Right? Of course, yes. Right? Interest rate differences will also be working in favor of these kind of borrowers. Right? These kind of borrowers. So I hope you understand these are the advantages. But there are certain disadvantages also. There are certain disadvantages also. What are the disadvantages? One, imagine you will borrow $1 today. Imagine you will borrow $1 today and the exchange rate is 50 rupees, and after 3 years you are supposed to repay it and exchange rate is 60 rupees. Please tell me, if you borrow in external market under ECB, if you borrow in external market in terms of a foreign currency, will you be facing exchange rate risk? Let me know. I'll repeat it again. Under ECB, you're borrowing from external market in a foreign currency. Are you not exposing yourself to exchange rate risk? Answer is yes. Answer is yes. And by the way, if you think of it, right, I wrote one term earlier, masala bond. And if you remember, I said what? Masala bond, the borrowing under masala bond, you will do in terms of domestic currency, that is rupee. So now tell me, under ECB route only, you will borrow from USA market in terms of rupees. I repeat, under ECB route, you will borrow, right, you will borrow from USA in terms of rupees. Are you facing exchange rate risk? Think of it and let me know. If you borrow in terms of rupees, not in terms of dollars, are you facing exchange rate risk? Listen to the question carefully. Some of you are not listening carefully. I am saying instead of $1, you will borrow 100 rupees. Are Baba, listen carefully. Instead of $1, you will borrow 100 rupees from USA market. Are you facing exchange rate risk here? How? If you say yes, please tell me how. Please tell me how. If you borrow in terms of rupees, of course you will pay in terms of rupees only. So how are you facing exchange rate risk here in the second case? Please tell me no. Please tell me. Enlighten me. How? What is your argument? How do you think you are going to face exchange rate risk? You will not face exchange rate risk. Right? That is the concept here in exchange rate risk. That is in case of masala bond, the borrower is not facing exchange rate risk. All of you will agree with me? Let me know. In case of masala bond, if you go to USA and from the market of USA, if you borrow 100 rupees, you are not facing exchange rate risk. The investor, the one who has invested, purchased your bond will face exchange rate risk. Right? We'll come back to this again. Please don't worry. Volatility in the exchange rate risk, if you borrowed in a foreign currency, is a concern for you. If the credit is available at a very cheaper rate of interest, if it is available at cheaper rate of interest, don't you think companies might become inefficient? Companies might not use the resources very efficiently. They might become more relaxed, more complacent, more access at cheaper rate. There is no guarantee that the companies will become efficient. They might become inefficient also. Third one will increase the dependency, right, on foreign funds, will increase the dependency for Indian companies, right? That is also concern. Fourth one, when companies will keep on borrowing, not only from the domestic market but also from the foreign market, right? Don't you think borrowing means repayment liability will also increase? And especially when you have borrowed in terms of dollars, there is an additional risk of exchange rate also. So don't you think companies would be taking higher risk when they borrow in foreign currency compared to borrowing from the domestic currency? Right? So that is also a concern. That is also concern regarding external commercial borrowing. So these are the advantages, these are the disadvantages associated with the concept of external commercial borrowing. Now let me go back to the earlier discussion, concept of masala bond. Concept of masala bond. Now come to the point here. Masala bonds, right? These can be issued by Indian companies, right? In addition to even global organizations outside India. Outside India. Point number two. When these are issued outside India, please understand, right? Understand this carefully. Example one. Example one. You will go to USA. You will issue a bond. Value of the bond is, right, let's say $100. Example one. Value of the bond is $100. So you are borrowing in dollars, you are repaying the amount in dollars. Can I say you are taking the exchange rate risk? Let me know. Think of it. Please think of it. You will go to USA. Example one. You will go to USA, issue a bond, value is $100. You will collect $100. You will repay $100. So don't you think you as an issuer, you are taking exchange rate risk? Answer is yes. Rather than this, imagine $1 is equal to 50 rupees. Rather than this, imagine $1 is equal to 50 rupees. You will go to USA market now. You will issue a bond. You will issue a bond. Value is 100 rupee. So now, can I say, by issuing the bond in values of 100 rupee, that is in terms of a currency, that is the domestic currency, you are borrowing in domestic currency and you will repay the domestic currency in domestic currency. Now the foreign investor has to convert the currency from the domestic to foreign, foreign to domestic. Any problem here? Let me know. Second example, you will go to USA, you will issue a bond. Take this only. You will issue this particular bond in USA, right? If I am the investor, I will have to convert my currency, domestic currency, that is dollar to rupees, purchase this bond. And right, once the tenure is over, or interest for that matter, you will pay me in terms of rupees only. Now I will have to convert these rupees into dollar. So now tell me, in case of this bond, second example, who is taking the exchange rate risk? Who is taking the exchange rate risk? Right? Can I say investor is taking the exchange rate risk? Some of you are saying borrower. How? How, my dear? Despite taking the example also, you are doubting it. How is the borrower taking the exchange rate risk? How is the issuer taking the exchange rate risk? Those who are saying issuer is taking, how? Please tell me. You are, right, or else, let me reverse it now. Let me reverse it. You are the USA investor. You have dollars. Agreed? You have dollars. I'm an Indian company. I'll come to USA. I will issue this to you. I will issue this to you. Tell me, please tell me, the value of the bond is given in terms of rupees or dollars? Let's go step by step. Value of this bond is given in rupees or dollars? It is given in rupees. So can I now say the value of the bond is denominated in rupees? Let me know. Can I say the value of the bond is denominated in rupees? So you are USA investor, you have dollars. I will come to you. I will issue this to you. Now you will have to convert your dollar to rupee. Give me rupees. And interest I will pay in rupees. So you will convert rupees to dollars. And upon maturity, I will give you 100 rupees. You will have to convert rupees to dollars. So at least now, please tell me between you and me, or else between borrower and lender, who is taking the exchange rate risk? Between the borrower or lender or issuer and buyer, who is taking the exchange rate risk? The investor. The lender is taking exchange rate risk. This is the concept of masala bond. This is the concept of masala bond. Now you will ask me a very simple question. Sir, if investor is taking the exchange rate risk, why will they invest? So what if I say, coupon rate offered on this is higher? Tell me now. Coupon rate offered on this is higher. So don't you think if the coupon rate is higher, investor, though they're taking a higher risk, they will be interested in such type of instruments? Bonds issued in the overseas market, these are issued and repaid in rupees. These are rupee denominated bonds. RBI mandates that original maturity period of 3 years bonds, the investment up to 50 million equivalent can be raised. And right, if the investment, that is they want to raise more than $50 million, then the bonds should have 5-year maturity period. The exchange rate risk in case of masala bonds is borne by the investor. It is borne by the investor. It is taken by the investor. Now, why do we use the term masala bond? Why not anything else? Why masala bond? The argument is very simple. The name for the bond is associated with feature of a country. I hope you understand this. The name for a bond is given based on feature, certain feature associated with a country. For example, let me ask you a very simple question. If I write a samurai bond, please tell me, if I write the term samurai bond, in which currency the samurai bond will be issued? Let me know. If I write a samurai bond, in which currency? In which currency these bonds will be issued? Can I say Japanese yen? All of you agree? Japanese yen. If I write a dim sum bonds, if I write the term dim sum bond, dim sum is basically momos, right? Dim sum bond is denominated in yuan, right? Yuan, it is denominated in yuan. Let me ask you one more, right? What if I say, right, baklava bonds? What if I say baklava bond? Baklava bond, it is denominated, right, in a Turkish lira. Lira is the currency for Turkey. Lira is the currency for Turkey. Turkish lira. So I hope you understand why these are called as masala bonds now. Is it okay? Why these are referred to as masala bonds? I hope that point is clear to you. Okay. Now, these are the different types of bonds. Now, I hope you understood, right? This distinction between the debt market is over, right? We have discussed all the concepts within the debt market. Now, let me shift to the equity market. Let me shift to the concept of, right, the equity market. Let's start. First and foremost, what do you mean by equity? Right, I'll come back to this, don't worry. First and foremost, what do you mean by equity? Equity represents ownership in any business. Simple. Equity means what? It represents ownership in any business. For example, imagine you will invest in a company and you will have 5% ownership in a company. Can I call this as your equity in the company? Shark Tank. I hope you understand Shark Tank. If you have seen that, they'll say, right, I will give you equity financing of 26%. I will give you equity of 10%. Right, I'll give you 25 lakh, but I want, right, 50% equity. equity represents ownership in a company. Simple idea. Now, many of you simply say, sir, I also came across the term share. I came across the term share. What is the idea of a share? How is it different compared to equity? Please understand. Generally, equity is represented in the form of percentage ownership. Generally, equity is represented in the form of percentage ownership. 10% equity, 100% equity, 51% equity, right? 8% equity, etc., etc. Whereas on the other side, shares represent units of ownership. I'll give you example. Please have patience. Shares represent units of ownership. So what do you mean by units of ownership? Look at the last part of the slide. I've given an example. Let's say there is a company ABC, and this company, let's say, has issued total 5 lakh shares. Right? Totally, they have issued 5 lakh shares. Now, can I say all these 5 lakh shares are individual units of ownership? Think of it. Right? The company ABC has issued 5 lakh shares, which means they represent individual units of ownership. But out of 5 lakh, imagine you purchased 20,000 shares. Out of all the 5 lakh, imagine you purchased 20,000 shares. Now, can I say 20,000 out of 5 lakh represent 4% ownership in a company? Any difficulty in the calculation? If you are having a doubt, sir, how come it is 4%? Use the calculator. 20,000 divided by 5 lakh into 100%. Right? So basically, argument is simple here. Shares represent individual units of ownership, whereas equity represents a percentage ownership. How much is the percentage ownership in a company? Right? Now, going forward, I'll tell you what types of shares are there. I'll tell you, please don't worry. By purchasing them, investor will get ownership in a company. These are tradable in the market, that is in the stock market. Right? For example, if you purchase Adani shares, can you sell those shares in the stock market? Yes. If you purchase a Paytm shares, right, that is 197, can you sell them in the stock market? Again, yes. Zomato, yes, these are tradable. Shares are usually measured in terms of numbers, whereas equity is measured in terms of percentage. Done. Now, come back to this idea. Come back to this concept. Please tell me, do you remember the idea of a primary market and secondary market? Let me know. Please let me know that you are revising. Right? That is how I will come to know that you people are revising. What is primary market? What is secondary market? Primary market is the market where new issue of instruments will happen. I'll repeat it. Please let me know whether you remember this or not. Primary market is a market where the new instruments are issued for the first time. Whereas a secondary market is a market where the instruments which are already issued are traded. All of you are okay with the argument of primary and secondary? Let me know. All of you are okay with the idea of a primary and secondary? Primary means the instruments are issued for the first time. New instruments will be issued. Whereas a secondary means the instruments which are already there, these will be traded in the market. For example, I'm an individual. I repeat, I'm an individual. We have done this circus multiple times now. I'm an individual. I have purchased the shares of Adani company. Now I will sell it to you. Can I say this is a secondary market? Simple. Can I say this is a secondary market? Second example, I am an individual. I'll purchase this share from Adani company when they are issuing it for the first time. Can I call it as a primary market? Very simple. Do not complicate it. Very, very simple. Okay. Primary instruments, new instruments are issued for the first time. Whereas a secondary instruments which are already issued will be traded. Now come to the point here. right? In case of the idea of a primary and secondary, there are two terms, IPO and FPO. What is the long form of IPO and FPO? Let me show it to you. Let me show it to you. IPO basically stands for initial public offering and FPO stands for follow-on public offering. Now, what is the initial public offering? Imagine a company is there. I repeat, imagine a company is there which is owned by three friends, right? Let's say three of you joined together, you started a company. Now, this company is performing very well. You have raised a lot of funds from the investors. Now, you want more funds. You want to expand operations. You want to purchase some other company, etc., etc. For multiple reasons, you want more money. In such cases, rather than you owning the company, now you will sell the ownership of company to the public. Very simple idea. Rather than you three having the ownership of the company, you will sell the ownership of the company to the public. Now, when you sell the ownership of the company to the public, can I call this as going public? Let me know. When you do this, that is, you sell the ownership of the company to the public, can I say you are going public now? Any problem in understanding this term? Please do let me know. You are going public, which means until now, you three were the owners. Now, the ownership can be purchased even by investors, such as you, such as me, such as banks, such as other institutions in the market. So whenever you do this for the first time, that is when you sell the shares to the public for the first time, it is called as initial public offering. Any problem here? Whenever you sell the shares, that is the company will sell the shares for the first time ever to the public. This is called as initial public offering. And whenever any company goes for initial public offering, we say company is going public, or else we will also simply say the company is now a listed company. Listed company means what? The company's shares are there in the stock market. You can purchase the shares from the stock market. You can sell the shares in the stock market. This is called as a listed company. For example, please do let me know. Is Infosys a listed company? I hope you understand. Is Infosys a listed company? Is Zomato a listed company? Right? Is right? Let's say Paytm a listed company. Yes, all these are listed companies. Right? So whenever companies will issue shares for the first time ever to the public, this is called as a listed company. Now the shares can be purchased, they can be sold. In simple terms, I will say shares can be traded in the stock market. Now, imagine there is a company ABC. It has conducted IPO in 2020. Can I call this as basically a listed company now? Yes. Now, the same company, which is a listed company, I repeat, same company, that is ABC, which is a listed company, can again issue shares in 2030. They can do that. They can again issue shares in 2030. They can again issue shares in 2045. But please tell me, a company which has already conducted IPO, can I say 2030 again it is going for IPO? Does it make sense to you? A company which has already conducted IPO, can we say again in 2030 it is going for IPO? No. Again in 2045 IPO? No. So please remember, once IPO is done, after that, any number of times a company will again issue new shares to the market. It is called as FPO. Right? Once IPO is done, after that, if the company will issue new shares again in the market, it is called as FPO, follow-on public offering. Right? A listed company will issue shares again in the market, which is called as an FPO. So, any problem with the term IPO and FPO? Right? Can we connect it to current affairs? Have you heard of Adani company? Let me check how many of you have read the newspapers in the last 1 year. Adani company, right? Please tell me, was the Adani company involved in IPO or FPO? Let me see, right? The Hindenburg report, the issue of Hindenburg report and Adani company. Was the Adani company going for an IPO or FPO? My dear, Adani company was going for an FPO then. Check it. Check it. Please check it very carefully. Adani company was actually going for an FPO, follow-on public offering. Adani is already a listed company. It is already a listed company, right? Which means the shares of the company are already traded. Don't you think? Again, understand this. Many of you will say, sir, right? How do I know it is an IPO or FPO? Right? I don't remember what happened. My dear, please tell me, once the report of Hindenburg was published, what happened to the share prices of Adani company? What happened to the share price of Adani company? Share prices took a hit. They crashed, they dropped, which means the company is already listed. Let me know, does it make sense or not? The share prices, that is the market prices of the Adani company, share prices took a hit. What does it mean? It simply means it is already listed, which means IPO is already done. So now they cannot do IPO. They will have to go for EFPO. Right? All of you okay with that? Right? So even in UPSC, just try to connect the dots like this. Many of the times by connecting the dots, you'll be getting the answer. Now, whenever you talk about shares, traditionally there are two types of shares. Whenever you talk about shares, so there are traditionally two types of shares. One is called as an equity share. Second one is a preference share. Understand the point very carefully here. One is equity, another one is preference. Now, equity shareholders are basically the owners of a company. These are stakeholders, equity holders in a company, and the dividend that is given to the equity shareholders, the dividend that is given to the equity shareholders, there is no fixed amount of dividend. There is no fixed amount of dividend. For example, imagine you purchase this equity share of Adani company. Okay. You purchase the equity share of this Adani company based on the profits, based on how much profits they've earned. In 1 year, you might get 3 rupee dividend per share. In another year, you might get 5 rupee dividend per share. In third year, you might earn only 1 rupee per dividend per share, which means there is no fixed amount of dividend that is given to you. If the company makes profit, the amount of dividend will vary from 1 year to the next year. But very important, equity shareholders will have a voting right. Remember this, right? The equity shareholders have voting right. Voting right means what? Imagine the company wants to acquire one more company. Imagine the company wants to change the payment for the CEO. Imagine the company wants to expand its operations. Don't you think they should take the approval of owners of the company? Think of it. Please think of it. In making certain decisions, don't you think the company, before they take the decision, should take approvals of the owner? Now, who is the owner here? Who is the owner? Can I say shareholders are the owners of the company? Any problem connecting the dots? Please do let me know. Any problem? All I'm saying is there are certain decisions which the company will take only after taking the approval of the shareholders. Now, that is approval. That is nothing but the concept of voting. The equity shareholders have a voting right. They can participate. They will vote. They will either say, this we will not approve, this we will approve. This is a concept of voting right. Now, come to the preference shareholders. Right? Come to the preference shareholders. Now, what is this? Preference shareholders. These are hybrid instruments. These are hybrid instruments. Right? What do you mean by hybrid instrument? Think of this very carefully. I will write the term bond here. In case of a bond, you will get guaranteed fixed amount of coupon. I hope you understand this. In case of a bond, you will get guaranteed fixed amount of coupon. That is, what do you mean by this, sir? Imagine the bond value is 100 rupee. It is a 6%, right? It is a 6% coupon rate, which means annually you will get how much? Fixed 6 rupee coupon. Any problem with this? Right? On the other side, if you are a shareholder, that is equity shareholder, you have ownership in a company. You have ownership in a company. Now, please have a look at preference shares. Look at preference shares. These are also types of shares only. You can purchase, have ownership, but please understand this. In case of preference share, they will carry fixed amount of dividend. They will carry fixed amount of dividend. Fixed means what? Annually, let's say 4 rupee coupon. Annually 4 rupee coupon. So, and from 1 year to next year, out of profit, how much coupon you will get, how much interest or how much dividend you will get, you will keep on getting 4 rupee every year. Every year you will keep on getting 4 rupee. Whereas in case of equity, there is no guarantee how much dividend you will get. You might get 3, you might get 4, you might get 5, you might get 8 also. Now, please have a look at it. Can I say based on this, preference shares have certain features of bond, have certain features of shares? Let me know. Based on this, can I say they have certain features of bond, have certain features of shares? Can I call this as a hybrid then? Hybrid means what? Mixture. Hybrid is nothing but mixture. Can I call this as a hybrid instrument? Answer is yes. That's the reason preference shares are called as hybrid instruments. Are preferred over equity shareholders whenever the dividend has to be distributed. And because there is a fixed amount of a dividend that is given to you, preference shareholders will not have any kind of voting right. Preference shareholders will not have any kind of voting right. So these are the two types of shares here. One is equity, second one is preference. Now let me ask you a very simple question. Let me ask you a very simple question. Are cooperative banks are they allowed to issue these instruments in India now? Let me know. Right? Are cooperative banks in India allowed to issue these kinds of instrument? Answer is yes. Right? Answer is yes. After 2020, these are allowed to issue. Okay? Can we go forward? If there is any losses in preference share, my dear, please tell me whether it is a preference or equity. Simple question. Whether it is a preference or equity, do you think shareholders will get money, that is dividend, if the company incurs a loss? Think of it, no? Whether this is equity or preference doesn't matter. I repeat, whether this is equity or preference doesn't matter. If the company incurs a loss, do you think, right, any one of them will get profits? No, they will not get profit. My dear, please understand why. Shares means what? Ownership. Share is nothing but ownership. If the company incurs a loss, how can owners get returns? Think of it, no? If the company incurs a loss, how can the owners get returns? They will not get returns. So again, do not complicate it. Do not complicate the issue. These are owners. Only difference is one set of owners will have voting right, but no guaranteed dividend. How much they will get, there is no guarantee. Another set of shareholders, they will not have voting right, but guaranteed dividend. Fixed amount of dividend every year. But dividend has to come from profit. Very simple. Right? Dividend has to come from profit. If the company doesn't earn profit, no way you will not be getting anything. Okay? Anything else? Anything else? I am a shareholder of so many companies, but no one is taking my approval. My dear, please let me know. If you are a shareholder, are you called for annual general meeting? Please check your mail. Please check your correspondence. You will come to know. You do not check it, right? I know many of you are shareholders in companies. I know. Will you get a correspondence regarding annual general meeting? What do you think happens in an annual general meeting? What do you think happens in annual general meeting? They will ask you for voting. Even without going also, you can appoint someone to vote in your favor. Even if they will not ask you to come physically, they will send mail also, ask you to vote. So I hope you understand, right? Voting is a very, very important part and parcel of equity shareholders. Only thing is that, and only thing is that you should be right proactive. You should be participating, right? Only then you will understand. Okay, sir, voting right is also there. Okay, done. These are the types of shares. These are the types of shares. Right. This is the idea for IPO, FPO. Now, right, primary market and secondary market. Company issues the shares to the public for the first time, which means it is going public, right? Initial public offering and the FPO, right? It is done in the primary market. Once IPO is done, the shares of these companies will be available for trading in the stock market, and we'll also say the company is listed now. Okay. Secondary market, best example for secondary market is a BSE and NSE. Best example is BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. So the companies, right, which are listed in BSE, their stocks are traded in BSE. Those which are listed in NSE, their shares or stocks are traded in the NSE. So BSE as well as NSE, very, very important, right? Let's say stock markets in India. We also have regional stock markets. Regional are not important, right? Regional not important, but the national level. At the national level, two important stock markets are there. One is a Bombay Stock Exchange, and the second one is National Stock Exchange. Okay, done. So this is basically the idea of a primary and secondary market, right? IPO, FPO, types of shares, what is a share, what is equity, etc., etc. Can we go forward now? Let me know. What can we go forward? Sir, what is Bank Nifty, Nifty 50? Please understand. Whenever you talk about stock market, whenever you talk about stock market, right, there is a concept of index. There's a concept of index. Index represents what? It basically represents what is happening to market capitalization. Now, don't enter into all of these details. For GS paper, I don't think so. You will have to learn about Sensex, right? Let's say Nifty, how many companies are there, right? Which 30 companies here, which 50 companies here, don't worry. But whenever you talk about index, for BSE, Bombay Stock Exchange, the index is called as Sensex. Have you heard of this? Let me know. Those people who are reading newspaper, have you heard of this? Sensex. And in case of NSE, this is called as a Nifty. This is called as a Nifty. What basically idea is, in case of BSE, we will measure what is happening to market capitalization of 30 companies. And that measurement is called as a Sensex. Whereas in case of NSE, rather than 30 companies, we'll take 50 companies. We'll take 50 companies and we'll measure what is happening to market capitalization of 50 companies. That is the reason this is called as a Nifty. That is basically the concept of Nifty. Okay, done. Now don't enter into calculation. Some of you are worried about calculation. I will not enter into calculation. That is not required for UPSC, right? How Nifty 50 is calculated, how Nifty Junior is calculated, not needed. It is GS paper. It is not a stock market class, right? There is a method of calculation, not at all needed for UPSC. Okay. Can we go forward now? Right. Let's go forward. Concept of P notes. Concept of P notes. Now, what is this idea of a P note? P note basically is nothing but a participatory note. P note means a participatory note. Now, what is this participatory note? Let me give you a very simple example. Let me give a very, very simple example. You will come across a term called as foreign institutional investor. Let me start with that idea. Now, there is a term called as foreign portfolio investors. There is a term called as foreign portfolio investors. Right? In short, you will come across right the term called as EFPI, foreign portfolio investor. Now think of this. Foreign means, can I say, any non-resident investor? Point number one. Please do let me know. When you say foreign, can I say any non-resident investor? Non-resident means the one, right, which is not residing in India, which is not there in India, outside. For example, what if an individual investor will invest in India's stock market? Possible? Of course, yes. Right? Just like you are allowed to invest in USA stock market. By the way, I hope you know this. If not, listen to me now. Can you invest in USA stock market? Answer is yes. Very simple. Can you invest in the USA stock market? Purchase a Tesla shares? Of course, why not? Can you invest in the USA stock market? Purchase Apple shares? Of course, yes. You are allowed to do that. Now, just like you are allowed to invest in the USA stock market, can I also say a USA investor, individual investor, might invest in India's stock market? Why not? Right? I hope you understand this. So, individual investors, they are allowed to invest. What about mutual fund companies? Foreign mutual fund companies? Of course, yes, they are also allowed to invest. What about insurance companies? Of course, yes, they are also allowed to invest in India. Now, understand the difference here. All of these examples that I've given, all of them collectively are referred to as EFPIs. I'll repeat it. All of them collectively are referred to as EFPIs. But please tell me, how many of them are institutions? Let me know. All of these are collected. Again, these are just examples. There are many more types of investors. But all of these are, right, foreign portfolio investors. All of them are FPIs. But out of these, right, don't you think second and third are financial institutions? Any problem here? Second and third are financial institutions. Now, please tell me, is the term foreign institutional investor okay with all of you? Let me know. Is the term foreign institutional investor okay with all of you? Right? Now, point number one. Let me go to point number two. The foreign institutional investor, whenever they want to invest in India, first they will have to be registered with SEBI, Securities Exchange Board of India. SEBI is the market regulator. SEBI is the market regulator. So, if you want to invest in India, you will have to be registered with the SEBI. Now, the point number two. Let me go to point number three. Imagine there is a foreign investor. Here is the investor. Okay, imagine there is a foreign investor who wants to invest in the India's stock market. But if they want to invest, first they will have to get the registration from SEBI done. They will have to go to SEBI, get right registration done. Only then they will be allowed to invest in India's stock market. Now, what if I say, you are the foreign investor, you will go to SEBI, you will apply for registration, it will take 2 months, it will take 3 months, right? Or you have given lot of documents, SEBI will ask for more documents, more proof of documents from your side, which will again mean what? It will take more time period for you to invest with SEBI, to get registered with SEBI. Now, please tell me, if you do not want to do all of this, if you do not want to wait for so much longer, don't you think you will not be able to invest in Indian market if there is no other option available apart from this? Yes or no? If this is the only method, this is the only method that you will have to go through SEBI, right? Wait for 2 months, wait for 3 months, get the registration done. Only then you will be allowed to invest in India's market. For many investors, they might simply say, this is very lengthy process for me. This is a very cumbersome process, right? So what is the point of waiting for 2 months? I will not invest in India. For such a type of investors, there is one more route available. There is one more option available, which is called as participatory note. For example, let's imagine this. This is a foreign institutional investor, right, from USA. Now, this foreign institutional investor will issue instrument. I repeat, will issue instrument. Imagine you are the investor. You are X. You are there in USA, right? I am a foreign institutional investor. I will issue this piece of paper to you. I'll collect your money and I will invest this money in Indian stock market. Very simple idea. Very, very simple idea. I'll repeat it again. You are a foreign investor, let's say USA. I am also a foreign institution. What I will do is, I will issue this piece of paper to you. By the way, this is participatory note. I will issue this piece of paper to you, collect your money, and I will use this money to invest in India. And this piece of paper that you purchase, that is called as participatory note. Can you see the picture now? Is the picture okay with all of you? Is the picture okay with all of you? Now tell me, can I say participatory note is an offshore instrument? Point number one. Can I say participatory note is an overseas offshore instrument? Anybody has a problem with this? Second point. Can I say if you want to invest in India now, right? You are a foreign investor, mind you. If you want to invest in India, you will purchase participatory note and through that you will invest in India. Can I say this? Right? If you're a foreign investor, now one of the option that is available to you to invest in India is through participatory note. You will purchase participatory note and that money will be invested in India. Point number two. Point number three. There's a term called as a derivative. There is a term called as derivative. Now, very simple concept. Do not complicate it. Do not enter into derivative market. There is a very large market within India's financial market called as a derivative market. Very complicated. Do not enter into all of it. What is a derivative? Let me give it to you in a very simple way. Derivatives are those instruments. I repeat, derivatives are those instruments which will derive their value from an underlying asset. I'll give you the example. Please have patience. Please have patience. I'll repeat it again. Derivatives are those instruments which will derive their value from an underlying asset. Meaning what? Meaning what? Let's go a very simple example. Imagine I will issue this piece of paper to you. I'll call this as a derivative. But I will simply say the value of this piece of paper is equal to value of rice. Simple. Right? I'll repeat it again. I will issue this particular piece of paper to you, but I'll say that the value of this piece of paper is equivalent to whatever is the market price of the rice. Now, please tell me, can I say this piece of paper, which is an instrument, is deriving the value from underlying asset, that is rice? All of you okay with this? Right? This piece of paper is deriving the value from an underlying asset. What is the underlying asset? Piece of paper. The rice here. The example that I gave, this is called as commodity futures. This is in simple terms called as commodity futures, right? That is a commodity is used, right, as an underlying asset, and this derivative will derive its value, from the price of commodities in the future. So gold, right? Gold can be used as a commodity. Agriculture commodities are used here. That's the reason you do not enter into derivative market. Derivative market is very complicated. For GS paper 3, absolutely of no use for you. But I hope you understand what you mean by derivative now. I hope you understand. What do you mean by derivative? I hope you have understood this. Now, let me go to the next point. Now. What is the use of all of this? Imagine I will collect the money from you by issuing a P note. I will collect the money from you. I will use it to purchase Adani's shares. Think of it. I will issue the P note to you. I will collect the money. I will use it to purchase the shares of Adani company. Now, can I simply say your instrument is going to derive value from the market price of Adani company shares? Yes or no? I hope you understand. There is one student says, if UPSC is not going to ask, why are you telling you, why are you telling me all of this? My dear, I am telling you all of this because of this. Right? Where is that term? Look at this. Right? I'm taking so much of pain and trying to convince you people because of this. Look at the statement of P notes. Please look at the statement for P notes. P notes are among the group of investments which are considered to be offshore. Anybody has a problem why this is called as offshore? Second, anybody has a problem why it is called as a derivative instrument? Right, tell me. Right, anybody has a problem why it is called as offshore? Anybody has a problem why it is called as a derivative instrument? My dear, this is the precise reason. This is a precise reason why I am discussing. Right? There are many students who will keep on saying, if UPSC will not ask, why are you simply disturbing my mind? Don't tell it then. My dear, I'm explaining only for a simple reason. Right? UPSC might ask you, is a P note type of a derivative instrument? Right? I hope you can understand this. They will ask you, is it belonging to type of a derivative instrument? Answer is yes. I hope you understand this. Okay. Done. So participatory notes also are referred as P notes. And more important in this example, let me know. In this example, can I say by purchasing P note, there is no requirement for you to get registered with SEBI? Let me know. Right, in this example, right, look at the example. By purchasing a P note, can I say there is no requirement for you to get registered with SEBI to invest in Indian market? Answer is yes. So these are certain important points regarding participatory notes. Please be very careful. These are financial instruments used by the foreign investors to invest in Indian securities market. The foreign investors need not register with the SEBI, right, for investing in stock market. Right, these instruments are very famously referred to as participatory note or P note. Next concept, credit rating. Next idea is credit rating. Very simple concept. Very simple. What is credit rating? Credit rating, just a second. Credit rating refers to the credit capacity or ability or the willingness of a borrower. Very simple idea. Do not complicate it. What is a credit rating? Credit rating represents the credit worthiness. Credit worthiness means what? What is the willingness of the borrower to repay the money? Right? For individuals, we have CIBIL score. For government, for companies, we have concept of credit rating. Now, credit rating is provided by credit rating agencies. The global three credit rating agencies, very important. The global three credit rating agencies are these three. One is S&P, Standard and Poor. Second one is Moody's. Third one is Fitch. All the three are very important. In fact, very often these are there in the current affairs. For example, can I say Fitch credit rating agency was very recently in the newspaper. Think of it. Fitch credit rating agency was very recently in the newspaper. In fact, I've asked you to read today's Hindu newspaper. Again, it is mentioned in that. Now, why these three rating agencies are very important? Most of the rating work in the global market is handled by these three. All these three are American companies. All of them are American companies only. More than 90% of the global credit rating is controlled by these three agencies only. Done? Right? Now, next point, last point. After this, we'll stop. Read the article today after this. Whenever you talk about credit rating, generally you represent the credit rating either in the form of only alphabet or in the form of combination of alphabet and number. For example, Fitch. will always provide a credit rating in the form of alphabets, and Moody's will provide in the form of combination of alphabet and number. And right, even S&P provides only in the form of alphabet. Now, what is the importance of these alphabets? Right, combinations you can say triple A, A1, A2, right, a triple B. These are alphabet combinations. So, what is the importance of these alphabets? Please remember this. If you keep on going downward in the table, if you keep on going downward in the table, we'll simply say credit rating is lower. Any problem here? I'll repeat the statement. If you keep on going downward in the table, right, meaning is credit rating becomes lower. Very simple idea. For example, do you remember your high school or even right? Let's say kindergarten, or let's say your lower level educations. That is, let's say first standard, second standard. Do you remember grades? Right? A person who has scored highest, they will be given a grade of A plus plus. Right? Somebody who has scored lesser will be given a grade of B. Right? Somebody will be given a grade of C. Apply the same logic here. Apply same logic. Argument is the lower, right, the grade will be, that is basically if you move away from B, if you go towards a B, C, D, what does it mean? Your performance is poor. Right? Your performance is actually poor. That's a basic idea. Apply the same logic here. The highest credit rating is a triple A. Highest credit rating is a triple A. And you, as you keep on moving downwards, credit rating will keep on decreasing. Right? And now tell me, if the credit rating is decreasing, don't you think by investing in such instruments, you're taking higher risk? Last point for the day. We'll continue tomorrow after this. I'll repeat the statement. As you keep on moving downward like this, are you not taking higher risk? Yes. If you're taking higher risk, what should be the coupon rate? What should be the interest that you're going to demand? Interest rate will start increasing. Please remember this. Please remember. Now, read the article today. If not, don't worry. Tomorrow we will discuss more about credit rating. Automatically, you will start understanding these kind of concepts. Okay, done. So let me take a pause now. Let me stop the discussion today here. Tomorrow we'll continue. Now, if there is any concern regarding what I've discussed, please do let me know. Sir, if the default, then would it not result in sovereign credit rating degradation as a disadvantage? Of course, yes. I'll discuss more about this tomorrow. Don't worry. Okay. Sir, we say that issue at discount and okay, already I've addressed it. Descriptive questions will take it up tomorrow. Don't worry. P notes are not understood. P note purchasing not understood. My dear, I am, let's say, an institution, financial institution. I will give you this particular right piece of paper. This is called as a P note. I will take money from you. You are not registered. I am registered with SEBI. I will sell this to you, collect money. I will use the money to invest in India. This is a participatory note. Okay. What is a derivative? What is a derivative in the concept of P note? I have given this P note, sold it to you, collected money, and I will purchase Adani shares. Shares of Adani company with that money. Now, please tell me, will the market price of Adani shares keep on fluctuating? Let me know. Will the market price keep on fluctuating for Adani company? Of course, yes. And because I've taken money from you to invest in Adani shares, can I say the value of P note? Because, right, the money I've used to purchase Adani shares, value of P note will also keep on fluctuating. So P note is deriving its value from the investment. That's a basic idea. Hybrid instrument, preference shares, there is a fixed amount of dividend. Fixed amount of dividend. Just like you get a fixed coupon rate in case of bond. And on the other side, you are a shareholder, meaning right, you are a owner. So the preference share will have a feature of a bond, a feature of a share, hence a hybrid. FII, one of the option for money laundering, And there is always a concern. There is always a concern that foreign investments, right, can be used, right, to basically convert black money into white money. Money laundering is a conversion of black money into white money. Okay. Who would decide to invest in P note? Foreign investors. Sorry, FDI will increase in India. Okay, when we discuss FDI, will take up this question. Don't worry. Uh, ODI, please explain again. What is ODI? I don't know, Baba. Green bond, not understood. Green bond basically means an institution, government, etc. They will issue bond, collect money, invest in only environment-friendly projects. That's it. Okay. Sir, are they allowed to invest via P notes always? Generally, huge amount of money is invested in India through P notes. Thousands of crores of rupees invested. Okay. Okay. So let me take a pause now. Let me stop the discussion. Tomorrow we'll start with the concept of credit rating from where we have left off. We'll start from there only. Okay. So take care. Have a great day. See you tomorrow sharp at 6 a.m.